Oh, well, thank you, sir.
Good.
Good morning, everyone, and welcome. I would like to call this public hearing of the Banking Committee to order on today, March the 10th. Before we begin, I would ask if my co-chair and ranking members would like to make a few comments. Representative Doucette.
Morning, Madam Chair. No, nothing really. Looking forward to getting into it. We've got a lot of interesting bills on our agenda today. So looking forward to hearing from everybody. Thank you.
Thank you, sir. And Senator Berthel.
Good morning, Madam Chair. Always a pleasure to see you and the other members of the committee. Yeah, we have a nice list of people that would like to share their comments and thoughts. And, you know, I think we all believe in the very strong philosophy and understanding that public hearings are the opportunity, one of the opportunities for the voices of the people to be heard. So what a great moment in the legislative process, and that is public hearings. So thank you for a few minutes to say good morning, and let's get to work. Thank you, Madam Chair.
Thank you, sir. I don't know if Representative Delnicki is here yet, Dawn. Has he arrived?
He is on multiple meetings today as well.
Yes. Okay. All right.
So he has said that he will pop in and out as possible.
I just wanted to give him the opportunity to say a few words if he was here. So just a few procedural things I'd like to go over. The list today, the speaking order would be public officials and legislators first in the first hour. If we run over that hour, if we don't continue, I should say finish the list, then we will start with the public and alternate between the two lists. And so I want to thank everyone. I am going to ask the committee members if you would limit your first round of comments to 2 questions so that I can give everyone the opportunity to ask a question. And then once we've had everyone's had that opportunity, then I will circle back to you. So for the public, we would like you to limit your comments to 3 minutes. We will, when it's time for you to wrap up and we see that you haven't wrapped up, then what we will do is that unfortunately we'll have to interrupt you and let you know that your time has ended. So again, thank you everyone for being here. Dawn Mazik is our clerk, who we couldn't do this without her, and she'll be our timekeeper. So let's start with our first, let's start with our first speaker. Dawn, who is that, please?
It's Treasurer Wooden.
Thank you. Good morning, Treasurer Wooden. There you are. I had to find you.
Hello.
Everyone's jumping around. So good morning. How are you this morning, sir?
Good morning. I am well. Excited to address you all.
Well, thank you for being here today, sir. The floor is yours.
Thank you, Senator Miller, Representative Doucette, and ranking members Berthel and Delnicki, and members of the Banking Committee. I appreciate the opportunity to testify in support of House Bill 5315, an act establishing a financial wellness trust fund and authorizing the treasurer to establish a Center for Financial Wellness. I want to thank the committee for raising this bill and tackling this important issue. As I've outlined in my written testimony, the lack of financial literacy in our state and across our country has damaging effects that can last a lifetime and impact generations of families. We all recognize the challenges that young people face as they struggle to pay bills and manage their money. When they lack a strong foundational understanding of personal finances, they are often vulnerable to expensive credit behaviors like payday loans, high interest credit cards, and exorbitant student debt. I remember my own first few days of college and an experience that you or maybe your children may have seen for yourselves. While walking into the student center, there were companies lining the walkway to sign teenagers up for credit cards tied to bad financial terms. In exchange for high interest rates and annual fees, a student would receive a trendy t-shirt or maybe even a poster. The lack of access to financial literacy resources also contributes to something I've talked a lot about, the racial wealth gap. When I kicked off my economic empowerment listening tour during my first year in office, my first stop was a professional development workshop on financial literacy at Wilcox Technical High School in Meriden. I heard directly from dozens of teachers who teach financial literacy. They spoke to the positive impact that their classes have on students and their families. I heard from parents who expressed thanks for having such a class, something they wish they had while they were in school. And I couldn't help but notice the majority of the schools that already had a graduation requirement for financial literacy were the more affluent school districts. And the numbers bear this observation out. In Connecticut, areas where 75% or more of students qualify for reduced or free lunch, only 1 in 14 will complete a personal finance course. And for schools with 50% or more Black and Brown students, only 1 in 20 have access to a personal finance course. We know that the simplest route to addressing these inequities is to require financial literacy as a graduation requirement in high schools. I have supported that effort, championing several bills in previous sessions. I am hopeful that one day we can prepare all students with the basic skills they need to manage in life, no matter which zip code they live in. Until then, it is crucial that we support the community organizations and programs that are trying to fill that gap now. The Financial Wellness Trust Fund will do just that. Through this legislation, my office can leverage our unique relationships with Wall Street and financial institutions to direct resources to these programs. To be clear, there are no state funds associated with this proposal. The primary source of funds will come from private sector contributions and grants. The treasurers of Massachusetts, Vermont, Kentucky, Tennessee, and Arizona have similar funds that their offices administer to support financial wellness programs in their states. In addition to the trust, the bill also authorizes the creation of a Center for Financial Wellness. This would be housed within my office. Currently, there is no entity that considers financial wellness challenges, opportunities, and solutions from a statewide perspective. The center will fill that vacuum and serve as a clearinghouse for financial education resources and support in the state. The need to increase financial literacy in Connecticut is clear, and my office is uniquely positioned to support this effort. I thank you again for this opportunity to testify, and I urge you to act favorably on House Bill 5315. Thank you.
Thank you, sir. Are there questions from the committee members? Representative Doucette.
Thank you, Madam Chair, and thank you, Treasurer Wooden, for bringing this forward. I think it's a fantastic idea. We first started looking at this with you and your office last year. For those who don't remember, we actually did pass legislation in the House, which had sort of an earlier version of this, not quite as fleshed out, but I'm happy to see that you all have done some work in the meantime to flesh this out a little more, to look at those other states, like you said, that offer these programs, and I think that makes it a much stronger proposal, and for the reasons you detail, I think your office is uniquely situated to act as the clearinghouse for these efforts, and we have a lot of great community groups that you can partner with, and I think we're going to hear from them later today. So I just think this is fantastic. As you mentioned, we do want this to be an integral part of our school curriculum. There are a few challenges and a few other parties and stakeholders that have to be part of that conversation, and those conversations are happening. But in the meantime, I think this is a great way to get at this problem, which is so important and so really pervasive. I think across all of our communities, across all income levels, I think we can all benefit from having more financial literacy or financial wellness, as you call it. I did just have one question, and again, because this is a brand new program, but we do have some other models in other states. What I'm wondering about is, the bill itself mentions, establishing a 501c3, So I guess the first question is, have other states done that? And then the second question, just, to make sure that, we have, or if there are any concerns about the oversight of this program. It is a fund, under the state treasurer's office. I imagine it would be subject to, audits by the state auditor when they are conducting the regular audits of your office. So I'm just wondering if that is true, and if there are any other oversight functions that we might want to think about while we're doing this, looking at adding to that.
Sure. So yes, we are contemplating a 501c3, which makes it advantageous to accept charitable contributions and raise funds through that means. We have models that currently operate similar to me serving as the trustee for our College 529 savings program, CHET, for the state. And I would envision a similar oversight model with a board of advisors. And so the oversight would be there with respect to kind of reporting on the program, very transparent. And
hey, that's great. Yeah.
And I should also add, thank you, Representative Doucette and other members here for the support last year and getting that bill passed in the House.
Thank you. Sure, my pleasure. So we'll take a look at that at the CHET, and maybe it's worthwhile to flesh that out a little more in this legislation. So we have a good comprehensive piece of legislation that's ready to go, and hopefully gets fully across the finish line this legislative session. So thank you again, Treasurer Whitten. Thank you, Madam Chair.
Thank you.
Thank you, sir. Representative Bohr.
Thank you. Co-chair, Senator Miller, and thank you, Treasurer Whitten, for being here. I too really like this program. I think it's so important that we prepare our young adults for financial stability, right? Wish we could do this for health insurance too, health insurance literacy. So my question to you is that I understand, the tax benefits that you're going to create, and these will be charitable donations through private or corporate funds. How will it be determined how the funds are disseminated? Will it be a competitive grant program that organizations apply for? Or how are we going to determine who actually goes out and educates our young adults?
Well, initially, so yes, people would apply. There's work that's being done currently in the state, like on a hodgepodge basis or program here, program there, that just need additional support. And this would be a vehicle, having this trust with resources raised, from the private sector and otherwise, that could provide that support that they would apply to the office for funding, for support.
So these are organizations that are already trying to help with financial literacy in the community. And we would evaluate those programs and they would apply for funding to help support them in their efforts.
Yes, that would be, I would envision that as one of the big recipients, beneficiaries of these resources. But there also could be a proposal for a new program in a community to provide it that we would review. And if it had merit, presumably support providing funding for it.
And is there a specific age that you have that we would be targeting?
No, not at this point. Right now, it's broad enough where you have, I've been very focused on young people, just in terms of building skill sets, tools, preparing them for life. But it certainly wouldn't exclude programs that address this with adults. I can think of, CRT, the Community Renewal Team. They run a program that deals with financial literacy for women who are adults. that would be a prime candidate for support, additional support.
And if a school wanted to put together a program.
Excuse me, Representative, I hate to interrupt you,
Did I already
but I
ask?
want, yes, 2
Okay.
questions, please. And I want to see if anyone else had any questions. Seeing none, you may continue, madam.
Okay, thanks. And if a school wanted to apply for funds, if they wanted to create a program like an after-school program, would they be eligible?
Absolutely.
Okay, all right. Okay, great, thank you. Thank you,
Yeah,
Madam.
and just to reiterate, I think our school system is one of the best vehicles to systemically touch all students, so that they would be very attractive candidates to support for programming.
Got it, great, thank you.
Thank you, madam. Treasurer Wooden, I want to thank you as well for bringing this initiative forth. And I noticed that you intentionally try to make sure that there are initiatives in this state to make us financially well, to make the residents of this state financially well, especially students. And I wonder if you could talk about baby bonds a little.
Sure, and yeah, and there's a perfect, I'm glad you asked that, because there's a really nice connection between the two. So baby bonds is a program that the legislature passed last year that I proposed, which creates a trust for kids born into poverty in the state of Connecticut. Poverty is determined by whether or not the mother is on Medicaid. And those kids, so approximately 16,000 babies a year born, they would have approximately $3,200 set aside in a trust that would be invested by my office over a period of 18 to 30 years. They could claim it at age 18 and only use for higher education, home ownership in Connecticut, investment in a business in Connecticut, or retirement security. And those are all metrics tied towards wealth disparities, in our state and in our nation. But in order to claim it, the young adults would have to be Connecticut residents at the time and have a financial education requirement certified. And so tying it back to this, right, having more, ultimately, I'd like to see that most of them say, yep, I got my credit in high school. But in the absence of that, a program like this just puts more resources into our state at de minimis cost to the state, and de minimis in the sense of, I have staff working to administer it, but to build that infrastructure for financial education and wellness in our state. The program is modeled, Baby Bonds is modeled off of a lot of the academic research done by Derek Hamilton and the New School. And there's a federal baby bonds proposal that Senator Cory Booker and Representative Presley have introduced that, I've been on Capitol Hill. They've invited me to showcase Connecticut. Connecticut is the first in the nation to pass such a program. And it's gotten, lots of national attention. Obviously we have one of the most significant wealth and income gaps in the nation. And so it's pretty noticeable to the country that we're first in the nation at having a program that addresses it. And the last point I want to make on that, although it is just by the nature of poverty, it is addressing wealth, race disparities, racial wealth disparities. But it's a program that's available to every poor child, irrespective of race, national origin, actually not national origin, born in Connecticut, but or where they live. And last year when we did this, we ran a list of every town in Connecticut. 169 of the towns had babies born into Medicaid. And so it is universal in that sense for our state.
Well, I do appreciate the work that you've done around this issue. And, we hear quite often that individuals need to pull themselves up by the bootstrings, but some of us don't have a bootstring. And so this will create that bootstrings for those individuals that are born into poverty. So I really do appreciate your foresight and you intentionally making sure that everyone in this state has the opportunity to succeed. And this will do that, especially the financial literacy piece. I know we see the thousands of dollars that our young people are graduating in debt. And so there's no way that they would have a start. They can't even start a life because they're paying off their debt. And so this would help them because financial literacy is very important. And Representative Berthel, I'm going to call you out because that's something that you've been really interested in since I've known you.
Yeah, very much so.
So I really do appreciate you bringing this initiative forth to our committee.
Yeah, and Madam Chair, if I could just, because I have to hop off before for that other 9:30 commitment. Treasurer, thank you for being here today and for the proposal. I think there's some really great ideas here that we can act upon and bring forth. This is an issue that we, I think, well, personally, prior to my joining the legislature 8 years ago, this was something I was working on just because I was involved as a volunteer in the credit union industry. And credit unions are, as I know you're aware, I believe you participated in financial reality fairs over the course of time. They're very interested in that. And so are banks. I don't mean to simply or uniquely call out credit unions, but I think it's beyond time for us to include this in model curriculum for high school and down to the junior high and middle school level, as well as considering some of the other options and some of the other ideas that you have built into your proposal. So I suspect there'll be some good conversation should this bill get to the floor of both either or both chambers. But that's what makes us good at what we do. I guess we're able to debate these issues and hopefully come to consensus on something that'll work. But thank you for being here. And I do have to run. I don't want to be rude and disrespectful, but
thank you. And thank you for your support for this issue.
Sure. Thank you. And Madam Chair, I'll be back.
Yes. Thank you. Thank you, right. Senator. Appreciate it. Representative Paolillo.
And Senator, if I could just comment on something you said, and you're thanking me. I want to thank the legislature for doing something not totally unprecedented, but it doesn't happen a lot in the building, which is pass legislation that won't have an immediate impact for years down the road, but appreciating that investment and how when we're talking about breaking cycles of generational poverty and lifting everyone up, sometimes we have to think really long term, and sometimes we think in election cycle terms rather than from a policy perspective long term. And so I really appreciate the legislature stepping up and supporting this in terms of baby bonds in the way that it has.
Thank you, sir. Representative Paolillo.
Thank you, Madam Chair, for the opportunity to ask the question. Good morning, Treasurer.
Good morning.
Being here. We had a chance to talk to you about a week or so ago at the bonding subcommittee level around baby bonds. And, I want to recognize your leadership again and pioneering that effort and bringing this forward and, really the dovetailing with this subject. Having represented New Haven and being in New Haven, a resident my whole life, and just thinking about as you're kind of preparing this program, can you just give an indication as to the boards of ed throughout the state who maybe have this type of program in place, as you're kind of, filling this need, which I think is a deep need and something that's so important, and coming from an urban area, and looking at, one of our high schools with close to 2,000 students there, how much of a benefit this would be even before folks get to college or start to make that first big purchase or to go to college or to start a small business or look at some of the benefits that now your baby bond program would bring to them, and the ability to think that large and to think that big. How many programs like this are in effect now with boards of ed where they're having this resource available for students to teach them about these basics?
The not not enough. And what I will say, I don't know about New Haven in particular, but I'm almost certain New Haven does not have a requirement around financial literacy. Unfortunately, there is a large correlation between like the most affluent communities in the state, those boards of eds and districts having the programs in place. With that said, I think there are a lot of reasons. Some of it's about resources. So if we solve for that problem, we can, for a district like New Haven, we could work with the Board of Ed to actually create a program and fill the gap from a resource perspective. And there's some other challenges, but there are not many in this. What I mentioned in Meriden, there were about 50 teachers from around the state, although I suspect there are more than that. And they're just very few districts require it.
So thank you for that, or able to do it as you mentioned, and I just find it when you mentioned the word correlation before, looking at our state with the financial services industry, with the insurance industry, with so many firms coming here, whether it be investing or hedge funds, insurance companies, property and casualty, with all of those backgrounds in financial services, I really want to say to you that there is that disconnect between what our folks are able to receive for education and for mentoring and for those resources. Basically, though, what we're called sometimes as the insurance capital, or wanting to draw other industries associated with financial services into here, but the lack of learning resources or learning programs. And so I would just say with a comment, thank you for bringing the private sector, with those contributions to be able to then to benefit, our residents, along with the opportunities that you're, going to pave the way for going forward with baby bonds. Because I would just say that to have this continued education and that resource available to students is going to make those dollars go even further. Those investments, whether it's going into education or starting that small business or making a major purchase with a home, you're able to stretch that dollar a little bit more with that background that you're going to be able to provide and that resource that you're going to be able to provide. So thank you so much for your continued work. And thank you, Madam Chair, for the opportunity to ask some questions today.
Thank you, sir. Are there any other questions from the members? Seeing none, Treasurer Wooden, sorry. Thank you so much again for testifying before us today, but especially bringing this initiative to the committee.
And
so we hope that we can get it over the finish line this session.
No, and if I could add one more thing, I think, and I'm going to speak in very strong terms now. I think it's legislative and policy leader malpractice for us not to get this done. There are very few initiatives that come before the legislature that has a zero associated with it and say, I just need this vehicle to help facilitate a bunch of other money coming to support communities. And so I'm going to be beating the pavement up there on this. And I know it's a short session, but and appreciate the effort last year and it passing in the House. But it's a shame that we've even lost a year of me being able to utilize these resources. As some of you may know, I'm the president of the National Association of State Treasurers. And so I interact with my colleagues and they introduce me to the institutions that fund their programs and say, oh, so anyway, so I will just close with that to say, if we can't get something like this done, I almost ask, like, what are we doing? So, so thank you all for your support and your interest in this issue.
Thank you, sir, and you have a nice day.
Thank you.
Okay, Dawn, who's next?
Senator James Maroney.
Good morning, Senator. How are you today?
Good, thank you. Good morning, Madam Chair.
You have the floor, sir.
Thank you. Co-chairs, Senator Miller and Representative Doucette, ranking members, Berthel, Delnicki, and distinguished members of the Banking Committee. My name is James Maroney, and I represent the 14th State Senate District, which covers Milford, Orange, West Haven, and Woodbridge. I'm here to testify in favor of SB 271, an act concerning student loans. And I'd like to start by thanking the committee for raising this bill and offer to continue to work with you as this bill moves forward to help improve the bill. I've submitted written testimony, so I am not going to necessarily go over all of that. I'll try to summarize in respecting your time. As we know, we have a student loan crisis, a looming student loan crisis. Our residents, the average resident in Connecticut has over $35,000 in student loan debt. Several years ago, this committee worked on a bill to offer a tax credit to partner with companies who would pay off their employees' student loan debts. So I would just, like to expand on that work, as there are some shortcomings in a tax credit. Namely, that tax credit only goes to C Corps. So the majority of people in Connecticut work for an S Corp or an LLC, so a smaller business, a pass-through entity. Also, if you work for a nonprofit or a municipality or government, that wouldn't help you. So what I would suggest is that instead of a tax credit, we look at creating a grant program through CHESLA to help pay off the student loans. Again, we're not asking CHESLA to forgive it. If we could provide them grants, and looking at $2620 of a grant per year for 7 years. And the reason for choosing that amount of money is the federal government has made it that you can pay off $5,240 of an employee's student loan without them having to pay income tax on that amount of money. And, ideally it would be a matching grant, but just recognizing that some of the municipalities or others, there may be labor contracts in place already. So we would like for the employees to be yielding at least some of that benefit. So again, going to 50% of the amount that you can pay off without them paying income tax, with the hopes that the nonprofit or the municipality would chip in the other amount of money, and perhaps limiting it to 7 years, which would get us to that. If they were forgiving $5,000 a year for 7 years, get us to that, forgiving the average amount of debt for a Connecticut resident. I applaud starting with the social workers, police officers, and fire workers, firemen, and ideally expanding this if we can see that this program works. The other thing I would like to look at is if we could add a study bill on here to ask, since Chifa, who runs CHESLA, works with the nonprofits. They have an active foundation. One of the missions of their foundation is workforce development. So to look at asking them to study career impact bonds, other ways of expanding workforce development, pay for success, and also working with the nonprofits through a concept such as active contract management. We know, again, we're looking to be a partner from the state. And we know that in addition to the student loan crisis, we're hearing of workforce shortages in a number of areas. So this would help us partner with municipalities and nonprofits to offer an incentive to help them attract qualified employees. So with that, I will stop and thank you for your time and your consideration of this concept.
Thank you, Senator. Are there questions from the committee members? Representative Doucette.
Thanks, Madam Co-Chair. Good morning, Senator Maroney. Thanks for bringing this one forward for us. Thanks for your work a couple of years ago on what was SB 72, I believe, in the 2019 session, which came through this committee, which we got passed, and is going to be going into effect in 2023, and now has the support of the governor to even expand that further in his proposed budget this year. A great model for something like this. I'm sure you saw, SB 271, we originally proposed it as a interest rate subsidy program. So we basically have, in my time here, two models. We have the SB 72 from 2019, which is a tax credit model. And then we had last year a bill for the Teacher Alliance subsidy program where borrowers would go through CHESLA if they qualified, refinance, get a reduced interest rate. So, choosing between those two models, I guess, it's a question. You have to sort of do the back of the napkin math to figure out which is sort of most cost effective, both for the state and for the borrowers. But I think this is a good one as well. So, I guess two questions are: have we done any of that back of the napkin math yet on what we would be looking at in terms of the fiscal impact here? And number two, would you also propose, you said this was a grant, you thought it'd be best as a grant program. Should we also have a tax credit attached to it, or is there any reason not to do that? What are your thoughts?
Thank you, Representative Doucette, for your work and for your questions. So first, with the interest rate subsidy, I think that works better when you are actually applying to school and looking to take out the loans versus when you already have the loans that you're looking to pay back. And I would actually argue that even more than, more effective than an interest rate subsidy would be in some form of a guarantee, meaning that you don't require a cosigner, right? If the state were to back up and guarantee a portion of the loans, because that's what prevents a lot of people who can't afford college from getting the loans, is if they don't have someone who's able to co-sign for them, right? And so I would look at that, and with that, I would look at targeted areas of need, right? So when we're looking to get people into, computer coding, we know that that's a way you can do a 2-year degree and get a high-paying job. So, and I think working with the Office of Workforce Strategy on identifying those targeted professions and how we can get people working and how we can make sure that we're able to get them the training they need. I personally feel that if you already have the loans, some form of a loan forgiveness, that the tax credit, historically as a state, we have not liked to give as many tax credits against the income tax. They've been more business tax credits. And so the income tax credit, that would assist an individual, right? If you could do an income tax credit. So that's one way to look at it. But, if you're a nonprofit and you're trying to use this as an incentive, I think finding the tax credits, since you're not paying, the taxes, or if you're a municipality, I think that some form of a grant, and perhaps we do need to study that, to see before how it would be implemented. As far as a fiscal note, I know that, the expansion of the tax credit, the governor is looking at $9 million. So, thereabouts, I look, through the budget, a cost. So, I would say maybe if you could use $1 million of that to be more targeted to try a program like this. When you're looking at, and, maybe you're limiting it to new hires, if our goal is to help recruit, right? Since we're saying, and again, it's always you're leaving someone out. So I'm sure there's someone who's working who's like, well, why do I get left out? Because if you don't retain people, then you need to recruit even more. So it is, but again, we're working with limited resources, and I completely understand what's the lever, right? How do we use our limited resources to maximize the return? And that's why I would say, try some form of a pilot program. As far as new police officers in the state, I was speaking with my chief, since that's one of the targeted areas. He would estimate we probably hire about 300 between the state and local new police officers in a year, and maybe 70% of them have a bachelor's degree. So again, that back of the napkin math, so you look at maybe there's 200 to 210 people who might be eligible in a year, but then again, that ramps up if you're doing it every year for 5 or 7 years. So that's why I think looking with, Office of Workforce Strategy and working with CHESLA to identify what's the way we maximize this return. And, I think I applaud you for envisioning the social workers, right? And we know that, I know, there's a tremendous need, right? We have a looming mental health crisis, and, the firefighters, and then maybe looking at other nonprofits as well. Again, I think that that's one of the areas we need to support our nonprofits. I think more as we know, with the declining state workforce, I think there's going to be more need for it, meaning that the actual state employees, not overall, but people who work for the state of Connecticut with the looming retirements and others. We're going to need to better partner with our nonprofits. So maybe this is another way we can do that.
Well, thank you. As I think you detailed, there's a lot of different options here and a lot of moving parts. So I'm sure we'll continue to be working on this. Obviously, we have a short session, short time frame, so we gotta move quickly. But look forward to continuing to work on this because it's important and it can be very impactful. It's just a matter of how we go about doing it. So, thank you.
Great, thank you very much.
Thank you, Senator Maroney. Are there any other questions from the committee members? Seeing none, thank you for joining us today and your insight on this bill. We appreciate it.
Thank you very much, Madam Chair.
Thank you.
Next, we have Representative Mary Wielander.
I'm determined to pronounce your name correctly, Representative Wielander. Good morning. How are you this morning? I know I saw her. She disappeared on me. There she is.
Hi.
We see you.
Good morning. Yes, thank you.
Good morning.
And yes, my name was pronounced correctly. I appreciate you asking. Honorable co-chairs Miller and Doucette, ranking members Berthel and Delnicki, and all of the distinguished members of the Banking Committee. My name is Mary Wielander, and I have the honor of serving the 114th District, which represents Orange, Derby, and Woodbridge. And I'm here to offer my support of SB 271, an act concerning student loans. Student loan debt is one that many residents face, which often comes with decades of negative fiscal implications on their futures. The prospect of this debt load also is a discouraging factor that may prevent people from exploring certain professions or career pathways. Right now, we are seeing an unprecedented need in certain areas, such as manufacturing and our first responders and community support careers, such as social workers. But the need for skilled employees extends across every industry. I respectfully ask the committee continue the good work started in the recent past toward debt forgiveness and extend those benefits to others, starting with law enforcement, firefighters, and social workers. Studies and anecdotal conversations with law enforcement leaders, such as my own Chief Gagne in Orange, have both shown specifically that police officers who have a college degree have less bias and use of force complaints lodged against them. Supporting this effort would be incredibly valuable to communities across the state. I echo Senator Maroney's suggestions of providing a grant of about $2,600 per year for up to 7 years to provide some benefit to employees, regardless of whether or not the municipal government decided to partner and match that grant. Being optimistic, running the program of 7 years would help pay off the average amount of student loan per Connecticut resident. This would give those residents more security and financial freedom in the years ahead, both of which provide long-term benefits for the state and the individual. I would also request that CHEFA work with the Office of Workforce Strategy to develop a plan going forward to identify in-demand careers for targeted loan forgiveness, so the state could continue to partner with our workforce needs. As part of that study, I would like to examine other creative means of developing our workforce and assisting our nonprofits, which we all know needs more assistance as well. To that end, I would recommend that the study look at and make recommendations on implementing the Pay for Success financing and active contract management pilot programs. Since CHEFA not only runs the CHESLA programs, but also provides financing for nonprofits, I also believe that they are the ideal organization to run the study in partnership with other stakeholders. Our family personally knows the weight that comes with long-term student loan debt. It has impacted every single decision that we have had to make as adults, and now even as we look to our own children's futures. I sincerely hope the committee and our legislature are able to take up meaningful steps that reduce this burden for others and improve the overall health, financially and socially of all of our communities. Thank you for your time this morning and for the committee for raising this bill and having this important discussion.
Thank you, Representative Welander. Are there questions from the members of the committee? Representative Doucette.
Thank you, Madam Chair. Hello, Rep. Welander. Thank you for testifying and bringing this forward. One question is, I know you serve on the Children's Committee, and I know HB 5001 is sort of our big children's mental health bill, which I'm not sure if that's in children's or public health, but I don't know if you were on sort of the team that was working on that and getting that put forward. I know in there's also a provision for student loan forgiveness. I think it's targeted at healthcare professionals. And with that in mind, I think we put that in there into this bill as well. So I guess my ask of you and everybody else who may be working on that or anything related to student loan forgiveness, student loan debt this session, that we kind of work together on all of this. I think we're on to something really good here in what we're talking about this morning. So I want to help tie that in to the other efforts everywhere else this session. So just ask for your help in doing that, and that we can get together and put something good together to help folks out.
Absolutely. Thank you for that and for your commitment and recognizing the need. I am on children's, and I was on the working group. I am on the working group that has been developing this legislation since last fall. And I'm actually going to be jumping to a meeting with them in just a few minutes. So if there are any specifics that you would like to make sure that we are either teaming up together or we want to make sure are covered between these two, please let me know and I can make sure to flag that. It is a comprehensive bill, and we are trying to make sure we target as many people as possible. But I think we've all can recognize that a multi-pronged approach to problem solving, such as large issues like this, is often much more effective than just hoping that one little Band-Aid will fix it. So I look forward to working with you on this issue.
Yeah, no, I guess what I would say is that, as we talked about with Senator Maroney, this committee has some experience working with CHESLA and creating programs with CHESLA. So I think we do have some expertise there, and we've had a couple of models that we've talked about that could be useful as in helping to put something together here. So yeah, we very much want to work with you all on that, and thanks again for testifying today.
Thank you for your time. Thank you, everyone on the committee.
Thank you. Are there any other questions from committee members? Seeing none, thank you, Representative Welander, for joining us today.
Thank you, Madam Chair, for your time.
Okay. Thank you. Dawn, who's next, please?
Matt Smith from the Department of Banking.
Good morning, sir. How are you today? We can't hear you. Can't hear you.
Oh, sorry, I was on mute. You think after 2 years, I would have learned that by now. Sorry about that. Thank
That's
you.
okay.
Thank you, Chair Miller, Chair Doucette, Ranking Members Berthel and Delnicki, and honorable members of the Banking Committee. As you know, my name is Matt Smith. I'm Director for Government Relations and Consumer Affairs at the Department of Banking. And I'd like to thank you for the opportunity today to testify on one bill. It's an agency proposal, SB 268, an act concerning various revisions to the banking statute. Some of this is a little technical, but I will proceed. Section 1 of the bill makes a clarification to a sales finance company definition and basically removes a provision that has struck some confusion in the industry about whether or not they actually own or a debt or if it's been conveyed. And we sort of take that out. And what that does is it makes it very clear to the industry that if you are servicing these types of loans, these sales finance companies, that you are subject to the jurisdiction of the Department of Banking, and therefore you are required to be licensed here in the state. So we think that that's a really positive change for consumers to make sure that consumers are dealing with companies that are subject to licensure here. The second sections 2 through 8 make various changes to our money transmission statute. And what this allows for is what's called network supervision. Money transmission is regulated state by state. And so industry usually will often have to have different regulations and different actions from different states. What this does is it sort of centers around a model law that states can participate in, and it allows us to rely on exams from another state that has a substantially similar law to ours. And we think that's important because it'll help reduce regulatory burden on the industry and have a more unified, more uniformity from state to state in the money transmission space. So we would ask your support on that part of the bill as well. The last section, section 9 of the bill, it raises the surety bond required by consumer collection agencies. So typically for any entity that's regulated through our consumer credit department, they're required to have a surety bond. And those bonds are in place in case, the company fails or they're subject to an enforcement action and they don't have the financial resources to reimburse consumers who may have been harmed through the result of some action or inaction that they haven't done. So what this does is for each main office location, it raises the bond from $50,000 to $100,000, and for each branch location, raises that from $25,000 to $50,000. And just to be clear, that's just the insurance that they need to take. They're not going to be, they don't spend $50,000 to, have the bond. Those bonds are generally a few $1,000s for the year. And so with that, that is the final agency bill. I know we spoke to the committee last week, but those are the final 3 agency bills that we have before you this session. And I'm happy to answer any questions you have on this or any other bill.
Thank you, Matt. Are there questions for Matt? Representative Doucette.
Thank you, Madam Chair. Hi, Matt.
Hi, Chair Doucette. How are you?
Good. A couple of things. Wanted to give you an opportunity to comment. We did receive some testimony I see here. I don't know if they're going to be testifying today, but from some industry groups of collectors and collection professionals who believe that the bond requirement is going too high and exceeds similar requirements in other states. Is that I don't know if any research has been done internally on this. Is that your experience, or do we think that this is in line, or do we think that it's just important enough to make that change?
I don't think that it is totally out of skew with other states. I haven't done the research on other states to see where they fall in surety bond, but I know the surety bond hasn't been increased in a while, different, as financial circumstances change and everything, we think that the added consumer protection sort of outweighs the relatively small cost that an increased surety bond would have for these different licensees.
Okay, I think that makes sense. And yeah, before we let you go, I just wanted to give you an opportunity to, if you wanted to comment on any other bills that implicate the department on our agenda today.
Yeah, so I think there are a few. First, the second agenda item, the concerning protection of elderly from financial exploitation. I just wanted to sort of just make a broad comment that this is a very serious and growing problem here in Connecticut and across the country. Nearly $3 billion, that's billion with a B, are reported lost from as a result of elderly financial exploitation. Oftentimes it's a family member, but there are people who who are out there who prey upon the loneliness and isolation that a lot of our elderly citizens feel. And so it's an important bill. And by the way, that's just reported. There are studies that suggest that the actual impact of this exceeds $100 billion every year that our seniors lose because, you know, scammers are getting increasingly sophisticated, you know, and they really do look out for, you know, these vulnerable individuals and prey upon them. It is a serious issue, and this bill, I think, is a good step in starting to bring that conversation a little bit more to the forefront. You know, so much of this goes unreported because there's so much shame that's attached to these people who become victimized by family members or, you know, other people. And so it continues to go unreported. So I think that I believe that there are some changes that some stakeholders, you know, wish to see in it. And, you know, we would be happy to participate in any discussions that, you know, advance the language of the bill so that, you know, we can see if we can, you know, get this out of committee and, you know, across the finish line, as the good chairman has said before about other bills. But it is a very serious issue that continues to plague you know, our elder citizens across the state and country. A couple of other things, I think. Senate Bill 272, an act requiring certain financial disclosures. Again, I think what you heard from the department last week was, you know, with 25% of our workforce retiring, many more ready to go. We have a lot of new people, and this bill would require additional staffing, additional training, because we really don't have the expertise in regulating commercial transactions. The department currently does not do anything in the commercial transaction space. So the issue presented with that bill would be our ability to enforce it, staffing, training, expertise, those kinds of things. Along with the student loan registry and the virtual currency space. The student loan registry, you know, the way the bill is written, it would require private student loan originators to register with the department. The private student loan industry comprises about 10% of the entire student loan market. Most of it, the lion's share, the vast overwhelming majority happens at the federal level. This bill also exempts banks and credit unions and other various entities. So we're not really sure at the end of the day where this really goes, right? Like who's being covered. In addition, all of anybody who extends credit in the state is subject to our Truth in Lending Act laws, abbreviated TILA. It is a federal law that is usually enforced in other states by the federal government. However, Connecticut was exempted out of that because our Truth in Lending Act is substantially similar to the federal law. So they're subject to the enforcement of the department through TILA. They're also any information or any data that you want to get from how a student loan was originated can already be done through our student loan servicing license. So we can get at any student loan through that power. So we think it's a little redundant. A lot of these companies are also licensed with us through our small lending license, which was a license that was established mostly to and successfully stop payday lending here in Connecticut. So we're unsure where that is going. And then the final bill, the virtual currency bill, again, I may be singing the same song we sang last week about the federal CRA. But interestingly, yesterday, President Biden issued an executive order on ensuring responsible development of digital assets. And I don't know if you had an opportunity to see it. We're still reviewing it. But on the basis of it, it looks as though, the Biden administration, seeing the significant impact on financial markets that cryptocurrency and other digital assets have commissioned all of the sort of federal regulators. So it's the Office of the Treasury, followed by the Federal Reserve Board, the FDIC, the Consumer Financial Protection Bureau, the Security and Exchange Commission, the Commodity Futures Trade Commission. All of these federal agencies that have a stake in whether it's financial markets, monetary policy, or consumer protections are commissioned to take a comprehensive look at establishing a regulatory framework that would address all of those issues. So leaving, again, the states in a quandary as to, is there anything that we can do? This, again, requires a lot more expertise on the part of the department and additional staff. But we do recognize that it is it's an emerging regulatory risk, and the department has continued to look at it and see what our federal counterparts have to say about it. I think that was a lot more than I thought I would go over, so I apologize for taking up all the time.
That's a lot.
I think
that's
sort of
that's helpful. Yeah, that's helpful. Thanks, Matt. Thanks,
thank
Madam Chair.
you. Thank you.
Thank you, Representative. Are there any other questions? Representative Leno.
Thank you, Madam Chair. Good morning.
Good morning, Representative.
How are we doing?
I'm doing well, thank you. How are you?
Very well, thanks.
Good.
I just could piggyback on your last answer here as far as the virtual currency. You mentioned if this bill goes through, you're going to need the department's going to need additional staffing.
Yes.
Can you explain what some of that additional staffing would be? What would be their duties? Why do we need them as opposed to current staff? And what's the cost for that type of expertise?
Okay, so again, we do think, upon reading the language would need, it sort of starts off as a registry, and then it goes into a bit of a licensure scheme. So we're not really sure, we'd have to nail that out. But typically, an industry that's licensed with us, we would require probably an additional 2 to 3 examiners. But again, that would also require, looking at how many companies are actually engaged in that, and Connecticut residents, and what would define, a company to be licensed here. And an additional attorney would probably be needed as these laws emerge and new laws need to be written, as well as regulations. So, and then, as we proceed through our examination process, and if we need to go to enforcement, that additional attorney would provide support for those activities as well.
Would the additional examiners and attorney, would their wheelhouse strictly be virtual currencies?
Considering that, so again, some of this depends on the feds, but this sort of straddles all 3 of our operational divisions. So there's an aspect that impacts our financial institutions, our banks and credit unions, right? And whether or not they can be custodians of these virtual currencies, which is still unclear at the federal level, right? It impacts our consumer credit division because it right now, virtual currency does have some regulation attached to it through our money transmission statute, right? So if a party is transmitting virtual currency, if a third party is sort of a go-between between transferring virtual currency between 2 other parties, then they're required to be licensed here in Connecticut. So there's some influence in there. Whether or not virtual currency constitutes a security would mean that it also straddles our Securities and Business Investment Opportunity division. So the interaction between all of these different financial sectors make it complicated. So the layer of complexity required by examination and the interaction of all of these different state and federal laws require, an attorney. I don't know
No.
if that got your question, but I hope it did.
Yeah, thank you. Under the present language in the bill, in 5320, do you think the language at all is putting the cart before the horse in such a way that we're going further than maybe where the feds are and where?
I think yes. I think we're definitely going further than the feds, and I think that at the federal level, and among I think many states, there is apprehension because nobody knows exactly what it is, right? Like the SEC hasn't determined whether it's a security, there's discussion, at the federal level of creating, a sort of digital currency that's backed by the federal dollar, which is interesting and would probably lead to regulation at the federal level. However, the whole point of virtual currency is to decentralize finance. So again, very complicated stuff that the department is really just beginning to sort of take a look at, internally and say, how can the state of Connecticut, strengthen its regulations, and then you always run the risk that whatever we do could be preempted by whatever the federal government comes out with. So it's a balancing act.
So we're going places the feds haven't gone yet. Conceivably, we could be getting additional staff that you mentioned, and then the feds preempt that.
Yes,
I say, okay. Thank you so much, Mr. Smith. That was good. Always good seeing you, and I appreciate your answers. Thank you, Madam Chair.
Thank you. Likewise,
thank you, Representative. Are there any other questions from the committee members? Seeing none, thank you very much for coming before us today. Great seeing you again.
Thank you, Chairman Miller.
All right, thank you. John, who's next, please?
Senator, it is Winston Berkman Green.
All right, good morning. Can you hear me? Great. Well, good morning, co-chairs Miller and Doucette and members of the committee. My name is Winston Berkman Green. I'm the Policy Counsel and Deputy Advocacy Director for the Student Borrower Protection Center. We're a national nonprofit policy organization focused on ending the student debt crisis. Prior to joining the SBPC, I was the student loan ombudsperson for the state of New York, housed in their Department of Financial Services. I'm testifying today in support of HB 5318, which would create a student loan registry in the state of Connecticut. We just heard Mr. Smith touch on it as well. So I have my prepared remarks, but I also want to weave in responses to some things that he said. So thank you for bearing with me. So first of all, I want to provide some context for the committee. So nearly 500,000 Connecticut residents owe approximately $20 billion in student loan debt. Based on national averages, and Mr. Smith mentioned this, about 10% of that, so somewhere between 1.5 and 2 billion, is likely private student loan debt. So not the majority, but certainly still a lot of money, right? And certainly a lot of money to the people who owe that in their household finances. The federal government regularly releases data about its own loan portfolio, state by state data and status of the portfolio, et cetera. And the terms of those loans are set by Congress. So there is very good transparency, or pretty good transparency, I'll say, on the federal student loan side. The private student loan market, on the other hand, has almost no transparency. What we know about this sector is mostly extrapolated from representative consumer credit panel data analyzed by the Federal Reserve Bank, or again, other sort of small snapshots, but they're not really a true snapshot of the state of affairs nationally or anywhere. The lenders who operate in this market are major banks and prominent non-bank lenders, but also some shadier companies that specialize in subprime debt, who target low-income borrowers, and also particularly in majority minority communities, I should note, and also work with some for-profit schools that themselves have very bad track records of taking people in for high-cost, low-quality education and leaving them saddled with debt they can't get a job to pay off. It's a very vicious but well-documented cycle. The legislature recently convened a post-secondary education finance working group to assist CHESLA in analyzing the sort of state of the student loan market in Connecticut, and we were a member of that group. And it became abundantly clear that it was hard for us to do our assignment, in part because there was no data on the state of private student loans in Connecticut, right? CHESLA had its portfolio. We can extrapolate. There's the federal, but there's just nothing on the private market in particular. Not unique to Connecticut, true nationwide. Some states, and the reason this is, and this is where I want to get into Mr. Smith's testimony too, is these especially the non-bank lenders, are simply not closely regulated by the Department of Banking. And this is true again in every state. It's not to their discredit, right? It's just the way that most of the industry is structured. He mentioned that this bill would exempt banks and they already licensed servicers, and that's fine. But those are only some actors in the private student loan industry. And I think what's really a pithy way of maybe describing like why we need this registry is if you all were to send a letter, or if the governor were to send a letter to the Department of Banks and say, who's doing private student loans in Connecticut? They just don't know, right? They simply do not know. And that's, again, not to their discredit. Most states don't know. So the point of this bill is just to add some transparency, sunlight the market. There are particular data points in the bill, and I'll touch on this in a moment too, that are going to be important for the state and for policymakers like you all to have. But it really comes down to this, probably to some people, very shocking threshold reality that like we just don't know who's operating in the private student loan market in Connecticut. And that's, again, a $1.5 to $2 billion market that affects nearly 500,000 residents. So there's also other aspects of the bill that will get at things the Department of Banking is not doing. For instance, it asks for certain data, but then we require the department to have a website, right, to share to consumers who's making loans, what schools do they go to loans with. The servicers are licensed, and Mr. Smith did mention that. That's true. You can get a sliver of this data from the servicers, but it doesn't get at some of the other data points that are in the bill, like which schools are the lenders making loans to attend? What are the outcomes for each of these loans divided out by school, right? There's some really interesting granular stuff that would that the state could benefit from if collected. So I'm going to pause there.
You could wrap up.
Yeah, I'm going to pause there. Obviously, lots to say on this, and I went a little bit off script because I wanted to address some of Mr. Smith's points, but happy to answer any questions. But the bottom line is, for you all to do your best job, we need data, right? And this bill would bring in much needed data.
Representative Leno.
Thank you, Madam Chair. Good morning, sir. How are you?
Doing well, sir. How are you doing?
I'm doing well. Thanks for your testimony. I just wanted to ask you a quick question. When you mentioned with this registry, looking at the schools, and I think you're looking at what the outcomes are. When you say outcomes, you're looking at maybe the success of the students getting gainful employment, how well they do after they get their degrees, and they're essentially on the hook for a good sum of money. You want to look at what those results are after they graduate and compare it to with what respective schools they go to. Am I understanding that correctly?
More or less, right? The way that this bill gets at that is by proxy. It looks at default rates by school, right? So this is ultimately a banking committee, banking department bill, and not an education. So it goes through the lens of the financial service provider. So it says you made loans to people to go to X, Y, and Z schools. What were the outcomes in terms of loan status and default broken out by X, Y, Z school?
Now, do you think there should also be some kind of a breakout or some kind of a metrics? Not also, I see your point on the schools, but how about also the program, the degrees? What type of degrees are being awarded at multiple schools, and what are those default rates?
I think there's a lot of merit to that, Representative. I think that probably starts to straddle a little bit more into the education space. That's not a bad thing. I don't say that to say it shouldn't be done. But I think that it's interesting when you see educators do financial services work and financial services work do education work. So I would encourage the committee to work with folks in other committees on that front. But I think the more data, the better. And frankly, in my written testimony, which I'll make sure Don and the committee gets, I have just a few high-level amendments I'm going to propose, and some of which is to get at more granular data, to your point.
Good. Thank you, sir. I appreciate it.
Thank you, Representative. Representative Doucette.
Thank you, Madam Co-Chair. Hello, Winston. Good to see you. Thanks
well.
for testifying, and thanks again for participating on the working group this year. Your contributions to that were great, and frankly resulted in the committee raising this bill. So thanks again. A couple of questions. One you've already touched on in terms of data that we could collect as you know, under current law, and as the Department of Banking is currently constituted with its staffing and its ability to regulate student loan servicers. I'm curious what data we could currently collect that would be useful to this inquiry about the state of the private loan market and what we couldn't. Okay, so I mean, I guess, and maybe this is a little too granular. I mean, I imagine through regulating servicers, we also get information about the underlying loans themselves, and we could try to get some data that way. But I guess it'd be helpful to know what we can and what we can't get at now. Okay. And the reason I ask that is because, the department has said, well, we do have access to some of this data. So if that's the case, what can we get now from them, through them, and what can't we get? So it'd be helpful to know that, number one. And then number two, if you could talk a little bit about the way we use the basis, I think, of some other state models that we looked at when our LCO staff drafted. We created these exemptions, and I wanted to know what your thoughts were on the exemptions that we currently have in there. Should we further amend those to get a broader picture of the private loan market?
Yeah, definitely. Thank you. So both great questions. So for the first question, in terms of the licensing of servicers and what information can you get there, you can probably get a very accurate snapshot of the health of the loan, right? Like, what is the status of the loan? How many loans are in repayment? How many are in delinquency, default, et cetera. You can, I would be surprised if the department wasn't already doing that. I can't recall having seen an annual report recently. I know that most states that have that licensure also have a student loan ombudsperson who sort of quarterbacks a lot of that work and publishes to committees, et cetera, data like that. I know that Connecticut does not have an ombudsperson, so I don't know the state of their reporting on that, but you can certainly get like a snapshot of the portfolio. I think it would be a little bit harder to get the servicers to hand over information such as like interest rates. Like, they could do it, they probably get a little bit of pushback. And same with the promissory notes. They might say something like, we're contracted to a lender, you have to go to them to get their model promissory note that they're using this year. Whereas the bill would say, give us your prom notes. I think the entire school part of it that a representative mentioned earlier would be much, much harder to get through the servicers, potentially even impossible to get. They might say, we get an account, right? I don't know where this kid went to school. I don't know where this 55-year-old went to school, right? We just have their account, we service it. And so we can't break it out by default by school or by school at all, right? I think that would probably be something also that they cannot do. They also, and I think I'll wrap up this part of it, I don't think they'd be able to tell you in as real time as this registry would, who's doing this business, right? And that's in part because servicers are not always also lenders, right? They typically work with lenders, but there could be people out there who are servicing their own. Or I'll take a step back. Part of what this registry is trying to do is get folks who are operating in sort of the shadow part of the market, who are really not in the regulatory fold, to be sunlit, to be sort of in the regulatory fold. There are some bad actors, some non-bad actors. The bad actors are probably not using reputable servicers, right? Which means they might not be licensed. So part of this is to do a wraparound of, let's make sure there's no one out here who's just like evading regulation and evading law. So we've touched the servicer side. At this point, Connecticut's probably wrapped up like anyone who's actually servicing, but there are going to be actors out there who are lending their own loans and servicing their own loans and just ignoring the Department of Banking. And this is another law that they'd have to ignore, but it's much harder for them to make the case that they can do that. So it's just a sort of soup to nuts. Let's get the lenders. Some of them might also be servicing, but I don't think you're going to get as much who's actively lending right now from the servicers themselves. So that's hopefully answering your first part. In terms of I have the bill in front of me, in terms of folks who are exempted, as Matt said, as Mr. Smith said, it is, I think, banks. And the reason that banks and credit unions are exempt is not because it's because they're already chartered, right? They're already licensed. So you already have the opportunity to get information from them. This is ultimately an information gathering bill. So we don't need to include people here who we can already get information from. And he did mention that some non-banks are licensed. The threshold for licensing non-bank lenders in Connecticut is 12% APR. If you're making loans underneath 12% annual interest rate, you don't need to get a license to do that, right? And although some subprime loans do go above 12%, vast majority are going to be under 12%, which means they are legally not interacting with the Department of Banking, right? So there's no need to have the banks here because there's no APR cutoff. If you're a bank, you have to have a charter. You're going to be interacting with the state or the federal government. The lenders, it's a little bit unclear. But most of them are probably not interacting with the state, particularly the shadier ones. So I didn't see anything that jumped out to me as needing to be changed there. I can certainly respond to any specific questions you have, but in terms of the exemptions, I hope that answers why some banks are cut out.
No, that's helpful. That is helpful. So, no, good. I appreciate your expertise on this. Again, I welcome you to continue to stay in touch with us. And as to my first question, as to specific data points and getting a better picture of that, anything you want to send as a follow up to that would be helpful.
I will do that. I will submit my written testimony, and quite honestly, like, I mean, no one is interested in doing work that doesn't have to be done, right? That's not my goal. I don't think that's your goal. And I think this bill does accomplish new things for the state. One way to test that theory, right, is to send a letter and ask the Department of Banking if they can answer some of your questions about the market. I again, not to their discredit, I don't want to bully anyone because it's just not what they've been asked to do so far. Most New York, where I am, cannot do this if you ask them. But that's a way to test that theory, because again, there's no point in passing a bill that can be done. I just suspect that the answer will be, we can't get this to you, or we can't get it to you quickly.
No, and the reason I ask is because we could do that in this bill. We could also ask them, in addition, if we wanted to create a registry, we create a registry. But in addition to that, we could also use this bill as a vehicle to commission a report from the department as to data that they can easily provide to us. So we could include that as a piece in this. So just wanted that for you to keep that in mind as well. So that's why I ask. We might be able to delineate certain things as this bill moves forward and we revise it. So Thanks again.
Thank you. Are there other questions from the committee? Seeing none, thank you so much for joining us today, and thank you so much for your work on this bill.
Thank you, Coach Miller. Have a great day, everyone.
Okay. You too.
Senator, the next speaker is Christopher Grimm.
Good morning, sir.
Hello, thank you. Thank you very much, Madam Chair, Chair Doucette, Vice Chairs, ranking members, and members of the Banking Committee. Thank you for the opportunity to testify in support of Senate Bill 272. My name is Christopher Grimm, and I represent the Innovative Lending Platform Association, ILPA. ILPA is a leading trade organization for online small business funding providers and servicers. Our members offer various commercial financing products and are proud to provide thousands of Connecticut businesses with working capital to invest in their business, purchase inventory, hire additional hands for the busy season, expand the business, or repair damaged or outdated equipment. Our members use innovative underwriting and the latest technology to quickly evaluate a customer's credit risk and provide financing in as little as 24 hours. ILPA is dedicated to advancing best practices and standards that promote responsible innovation and access to capital. ILPA strongly supports transparency in small business financing disclosures, and our member companies are committed to providing small businesses with responsible and transparent financing options. In 2016, ILPA created an industry-first model disclosure tool, the SmartBox, that presents small business borrowers with comprehensive pricing metrics and identifies key loan terms in plain, easy-to-understand language. This is why ILPA supports this bill and why we supported New York's commercial finance disclosure law that this bill is very heavily based on. We believe small businesses are empowered when presented with easy-to-understand metrics and can compare cost, term, and other critical metrics across different providers and different products. We do have one small request for an amendment. We are asking all the states that are considering this legislation, and there are a number right now, to create a mechanism for use of forms across multiple states. And so we're asking every state's regulator to approve disclosure forms that are in use in other states that meet or exceed the requirements in that state. So in this case, we would ask the Connecticut Banking Department to approve forms that are used in other states that have the same or greater requirements in their disclosure laws, just to ease the regulatory burdens across states. Our members operate in all 50 states. We definitely support this bill and feel very strongly that disclosure is important for small businesses and important for the industry. I just want to make sure that we don't run into any unforeseen regulatory hurdles, as there are always some slight differences between some of the states and what they're requiring and how their forms are laid out. So that's just a small thing that we would like to ease compliance. Other than that, we really appreciate the committee raising this bill. We were very, very supportive of New York's law and worked on 2 years on that language to get that passed through New York. We're supporting similar bills in other states. We appreciate the committee's consideration and ask for the committee's support on this bill, and I'm happy to answer anyone's questions.
Thank you, sir. Representative Doucette.
Thank you, Madam Chair. Thanks, Chris. Good to see you again. I believe you were here last year.
I was. You saw this face in a box on your screen a year ago.
Right. You know, at that time, as you may remember, this bill was brand new, and this concept was brand new to us. We had some discussions last year. We did not feel we had enough information, I think, to move it forward at that time. And as you may appreciate, if you work with other state legislatures, you know, we were under a time crunch at this time of the year when we're moving legislation forward, and we have to decide whether or not it's you know, it's ready for prime time, so to speak. So I appreciate this. One question I have, and because we've already received, and we received last year, some comments that the APR is not the proper regulatory mechanism, or in terms of disclosure for this type of lending product that we're looking to target, that it's obsolete, or that it doesn't really capture, you know, it's not an adequate disclosure tool. What's your thought on that?
So ILPA included APR in our Smart Box. We believe our small business customers expect to see APR because they see it in other financing products. I don't know that anyone here or any one of our small business customers would understand how to do a calculation for APR, but they understand that it is a cost comparison metric, one of several, right? It is not the be all end all metric. Anyone who's had a mortgage, right? Like I got a 4% mortgage when I bought my house, and I was ecstatic until I saw the total cost that I was paying in interest over 30 years, and I could have bought another house for that. Where a 15-year mortgage may have had a higher APR, but a lower total cost of capital. So we believe that folks expect to see APR, that it helps to do comparison across different loan products, but it is not the be all end all. When combined with total cost of capital, the term or the estimated term of the financing agreement, your estimated monthly payments, it is just one of, you know, a handful of very important metrics. We think that it's important. Others, you know, are certainly free to disagree.
I mean, do you think, just to get more direct, I guess, do you think that the criticism of APR in this context is just that the sticker shock that people in seeing that high number would not want to get one of these loans, and that's why some of the folks in this space don't want it disclosed?
Our members who've been disclosing APR since 2016 have not seen that happen, but I can't speak for other people's business model or the market. Right? When you're talking about a very short-term financing, 6 months or less, really anything under a year, the APR gets inflated. And if you're comparing something that is a 6-month financing term to a 10-year financing term from, say, a small business loan, the APR is going to be wildly different. The businesses that we serve are underserved by banks and are underserved by you know, some of these programs that are out there. So they're not comparing our products, right? They're not comparing a 6-month term loan or a 6-month you know, a sales-based financing agreement with an estimated term of 6 months. They're not comparing that to a bank loan. They're comparing it to other products in this space from our point of view. But other businesses may have a different market that they serve, may have a different you know, constituency. I can't speak for them. I just can say that our members have not seen any issues or chilling effect from disclosing APR as part of SmartBox, and don't anticipate any complying with New York or California.
Yeah, no, I get it, but I think it still is useful. It goes to, you know, to the cost of capital. So, well, thank you for your testimony. Thank you also for those amendments. You said you're going to submit those, or if you haven't yet, and because I would definitely like to see those, and definitely like to get feedback from the Department of Banking. As you may have heard earlier, they always have concerns about staffing and new programs or new regulations coming on. So anything that makes it easier, if in fact that's what it does, would be appreciated for sure.
Absolutely. Happy to do it.
Thank you.
Very much.
Thank you, sir. Representative Delnicki, thank you for joining us, sir. You were able to make it.
Thank you, Madam Chair. I was tied up with another committee, believe it or not. There's a couple of things going on today. Chris, great to see you again. You spoke to underserved businesses in banking. Can you tell us what kind of businesses would be underserved in banking?
So I think right now, especially after the Great Recession, capital for really small businesses dried up. And if you think back, 2 years ago when the PPP program first rolled out, all the news stories that came out, very early on in the program was Smith & Wollensky got $18 million, right? And professional sports franchises. Because the definition of small business gets pretty big, right? So the quote unquote small businesses that have banking relationships, business banking relationships, are really big small businesses. For a really small business to get 10, 20, 30, $50,000 in loans from a bank is really hard because the underwriting costs the same to underwrite a $10,000 loan as it does to underwrite a $10 million loan. So there's really there's really sort of a niche in the market that's not being met by current banks, and part of that has to do with the risk profile. I think everyone on this committee has probably heard the stats thrown around that 50% of businesses fail in the first 5 years. It's one of the big differences of why commercial and consumer finance is regulated differently, because it's a much different risk profile. So you combine all of these factors together, and many small businesses just don't have the same access to financing and capital that larger businesses does. And they need it quicker, right? They've got cash flow issues, banks turning around loans. I mean, again, not to belabor talking about mortgages, but when I refinanced my mortgage, it took weeks and weeks to get everything done. And so, when small businesses need a quick infusion of cash, they need something that's in their bank account in 24 to 48 hours, something that they can do online. They don't have existing business banking relationships. We're there to meet their needs. And that's sort of the niche in the market that we're serving.
Specifically, can you identify actual types of small businesses that benefit from this?
So it's any small business that is really small, right? Most of our members are providing financing to businesses with 20 or fewer employees, right? The SBA definition of a small business is 500 employees. That seems huge to me, but I guess compared to really big businesses, they are small. And so it's anything that falls under that category. My dad owned a pizza place in New York for a long time, and if his pizza oven would break and they need to get a new one in to keep the doors open, this type of financing is perfect for those situations. We have members who are those types of mom and pop main street businesses that often just need a quick infusion of capital to expand, to hire people, to purchase inventory. A lot of businesses are seasonal and have cash flow issues because of that, and need financing to keep the doors open and keep people on payroll, during the slower times. And those are really the businesses that we're serving.
And lastly, you mentioned estimated monthly payment. How is that calculated? What the estimated monthly payment would be, and how is the stability in that estimation typically for the small business?
So it varies by product to product, right? There are a number of different products covered under this bill. Term loans, which everyone is really familiar with, right? You've got a set financing amount, a set finance charge, your monthly payments, and your APR are all fairly straightforward and fairly fixed. Lines of credit which operate more like a credit card. And again, I think there's a relative degree of familiarity there and what your minimum payments would be once you take
Well, I
draw
think
from a line of credit. There are other products though. I'm sorry, sir. There are other products though that don't have set payments. So they're alternative financing. The provider is providing capital in return for purchasing a percentage of future revenue. Sales-based financing or merchant cash advance, these products are called. And it's really more akin to someone taking on equity, but instead of having, Mark Cuban on Shark Tank getting 5% of a business forever, the provider here gets 1% of daily sales until they hit, the certain amount that the business has to pay back. And so the estimated payments then on products like that are just at an estimate. The provider would have some insight into what the average daily sales are, and then can predict how long it would take to reach the repayment amount, and then would calculate, what the daily, weekly or monthly payments would be from there. And this bill, as well as New York's, lays out different ways for the providers to come up with these estimates and calculations. And for the business, these products are really useful because they're so flexible. Again, seasonal businesses, or if a business is closing for repairs or renovation, 1% of zero is zero. So in those months where business is lean or you're not open because you're doing work on the premise, you're not paying anything back to the provider. Your payments are zero. And then if months that are really good and business is doing really well, you're paying things back much quicker then. And that flexibility is one of the benefits of those products. So that's why there are some instances where there's an estimated monthly payment, an estimated APR, because of that inherent flexibility.
So then lastly, this is just an observation, and you can correct me if I'm incorrect here. So this is sort of like an alternative to taking a line of credit out on a credit card, number one. And number two, is there any prepayment penalty whatsoever if one person, say, had the 1% of the income of the business and suddenly they have a tremendous month and they say, hey, look, I'm going to pay the whole thing off right now?
Mm-hmm. So the cost of financing in these sales-based financing agreements is fixed. So unlike a loan where if you pay early, right, if you pay your mortgage $100 above what your minimum payment is every month, you'll shave some of the interest off on the back end because you're shortening the term. With these products, the cost is fixed. So there's no prepayment penalty. There's no prepayment benefit, right? Because it's just that percentage draw from the recipient until the target amount is hit. So it's sort of neither a penalty or benefit. It's really just built in to be flexible for the business owner.
Well, thank you for your testimony here, and thank you, Madam Chair.
Thank you.
Thank you, sir. Representative Lanu, did you want to ask a question, sir?
Thank you, Madam Chair. The gentleman did answer it, so I'm all set.
Okay, all right, sir. Are there any other members who would like to ask Mr. Grimm a question? No. All right, thank you for your testimony today.
Thank you very much.
Senator, next is Ed Lang.
Good morning, Attorney Lang.
Good morning, Senator Miller, Representative Doucette, Representative Delnicki, members of the committee. My name is Edward Lang. I'm an elder law attorney in Middlefield, Connecticut. I am the past president of the Connecticut chapter of the National Academy of Elder Law Attorneys, member of the executive committee of the Connecticut Bar Association Elder Law Committee, and Senator Miller, a proud graduate of Stanford High School. I'm here today to ask you to not act favorably on Senate Bill 269. Not that it's a bad concept, because as we've heard from Matt Smith, as you'll hear from others, the problem of elder financial abuse and fraud is very serious, it's very prevalent, and I would encourage you to enable us to create a working group of interested parties, the Connecticut Bankers Association, possibly the AARP. I was delighted to hear that Matt Smith is interested in working on this group. There's so many issues involved that I think with some cooperation of some of the key players, we can come back to you with a comprehensive solution or some suggestions that will eliminate a lot of the problems that exist with the current proposal. We as elder law attorneys are very concerned that the bill as written allows financial institutions, banks in particular, to put freezes on accounts based on the reasonable interpretation of bank employees. There are no particular standards, there's no right of remedy, there's no particular ability of people to take steps to speak to trusted contacts. We are concerned if someone is in the process of applying for Medicaid benefits and we need to move funds out of that individual's name to their spouse or to a disabled child, and the bank places a freeze on the account because they see these transactions, then the Department of Social Services will say the person is not eligible for Medicaid benefits because they're over assets. Perhaps we need to include a definition that says if a bank does this, it's going to be treated as an inaccessible asset for purposes of eligibility. Allowing the banks to put freezes on accounts can conflict with the current law concerning powers of attorney, where banks have a limited period of time to hold funds until they can verify the power of attorney. But that conflicts with what we're being presented with now. It's conceivable that we should come up with a solution that if a bank sees this language, they have to give notice to people. I'm very concerned about what happens if someone has automatic payments to credit cards, utilities, insurance, and the bank puts the freeze on that. What happens to those payments? I'm also concerned about joint bank accounts held between spouses and one spouse is being victimized. Does that mean the funds of the other spouse can't be accessed? My point is there are lots of issues with the current bill, and I'm asking you not to go forward with that bill as it's been presented, but allow us the opportunity to work with some of the people who've already stepped forward and indicate that they have an interest in this bill. Connecticut NALA is certainly willing to actively participate in that process. The National Academy of Elder Law Attorneys has already been studying the issues of financial fraud, and in particular, the issue of how do we recover assets once someone's been victimized. So I'd appreciate the opportunity for you to allow us to work together. I think we can come back and do something better.
If you could wrap up, sir.
I'm all done. Thank you very much, Don.
Thank you, Attorney Lang. Are there questions from the committee? Seeing none, thank you, Attorney Lang, for joining us today.
Thank you very much.
Senator, next is Richard Gumbrecht.
Good morning, sir. You're on mute.
If you could unmute, sir.
There you go.
Okay. Good morning. Thank you, Chair Miller, Chair Doucette, to the rest of the committee. Thank you for giving me the opportunity to speak this morning. I'm Rich Gumbrecht. I'm the CEO of the Secured Finance Network, and I'd like to speak on the subject of SB 272, the act requiring certain financial disclosures, and maybe build upon the comments that were just made a few moments ago by Chris Grimm with the ILPA, although our perspective on this bill is that we're not in favor of a number of elements of this bill, although we do greatly support the idea of transparency. And so I'd like to share a little perspective on how we're thinking about this. Our organization is a nonprofit 501c6 organization. It's been around almost 80 years. It includes banks and non-banks who provide essential capital to middle market companies in the country. Actually, over $1 trillion of capital is deployed by companies that provide asset-based lending and factoring and supply chain finance, which are the primary products that we offer. The defaults on those products are typically, and actually have been over the last 25 years, as we've measured it, less than 1%. So these particular commercial products are offered in partnership with the borrowers that result in very positive outcomes. I know there was a reference in the discussion with Mr. Grimm about mom and pop companies. Typically, these products are not offered to mom and pop borrowers. They're companies that have somewhat more sophisticated resources that they require term sheets. And in fact, we have a standard of business practices in our industry that every proposal does require a signed term sheet with it. And are almost always the borrowers are represented by counsel and have the ability to understand the intricacies of these products. They provide working capital. We have about 50 of our members or more do business in the state of Connecticut. They deploy between $10 to $20 billion of capital that's outstanding currently. And our position would be that we would like to ask that those companies that are providing these detailed term sheets would be excluded from the measure, and that those asset-based lenders, factors, trade finance companies that do not provide such term sheets would be required to provide a set of disclosures that can be complied with. And our biggest concern is with this issue of APR, which came up previously. And the reason,
if you could wrap up, please.
Okay, the reason being APR is a commercial, is a consumer measure, and I'd be glad to answer any questions about why it wouldn't apply to these specific commercial finance products.
Thank you, sir. And so why wouldn't it apply to these particular products?
I got my comment before my time was up. So the reason is this, that these products are based on, unlike sales finance products, which Mr. Grimm talked about, which are typically the merchant cash advance products that are based on future sales. These products are based on current receivables or inventory, current assets that become part of the company's borrowing base. And the borrower has the ability to utilize these facilities to provide working capital to fund their day-to-day operations. But there is no ability for us to see forward in terms of what the demands are going to be for that capital. So if in a given month there's very little inventory purchased, or the company has declining sales and don't need to draw on these facilities, then the outstandings could be zero. And to apply any potential fees or anticipate what the draws would be, and these change daily. They're highly monitored. There's a borrowing base that's reviewed between the borrower and the lender. And the dynamics of that are such that trying to establish what an APR would be at the beginning of a transaction would be essentially a needle in a haystack in terms of getting it right. But we do favor providing disclosure about here's the spread over a base index, so your rate is 400 basis points over LIBOR. The amount that you can borrow against your assets is 50% of these various classes, and here are any fees that are associated with this. So all of that is part of our disclosures in our industry.
Thank you, sir. And before I call on the members, I want to remind you to please limit your first set of questions to 2 questions, and I will circle back to you after other members have asked their questions. Thank you. Representative Doucette.
Thank you, Madam Chair. I'm getting very good at this 2-question thing. I've got 2 questions for Mr. Gumbrecht. Thank you for your testimony today. The first question is about if you could expand a little. You talked about exclusions and sort of delineating between the type of borrower and the type of loan that's being made, and you referenced the mom and pops. I think the mom and pops is first and foremost, as I look at this legislation, our primary concern. In that hearing, and it was brought to us last year by Senator Anwar, who had a few stories that he had heard from constituents. I myself in my law practice have small businesses that have gotten themselves in trouble with some of these merchant loan products. So that I think is the root of the concern. So if you could expand a little upon the ways to exclude, to delineate between maybe more sophisticated borrowers, more sophisticated products that, like you said, already have some disclosures happening in a term sheet. I guess that makes sense. At the same time, though, I guess we wouldn't want to, also waive all the rules for disclosures in some of those contexts. But so where do we draw the line? Where's the right place to draw the line?
Yeah, I don't think you need to waive disclosures. I think that companies that provide these kind of detailed term sheets, and we can provide to the committee the illustrative examples of the kind of information that's provided, and we can use that as a basis. Companies that wouldn't provide it, I favor the idea of having transparency. And look, we hear stories all the time about small businesses and pizza shops that that took a merchant cash advance, and their business declined, and so ultimately, and they can't be released from that obligation, and they end up paying 200% APRs on those products, which is criminal. And but you ask where we could draw the line. We can work with you on establishing what the size organization would be that these disclosures would be required for, and we're very much in favor of that. But it would be, in our view, it should apply to those small businesses that don't have the access to legal review or the capability to understand these proposals, and those are the ones where the abuses are taking place. So we could work with you on what we think that line would be.
Okay, that would be appreciated. And if you haven't submitted written testimony or want to send something as a follow-up, any thoughts on that would be appreciaed. Yep. Second question is, it came to the attention of the committee recently that Connecticut's being used as a venue for a lot of the lenders in this space because of what is viewed as favorable judicial process for attaching assets through prejudgment remedies. So there's a default, there's an action initiated in court, and that the secured party, the lender, is able to attach assets immediately, like bank accounts. Is that your experience? Is that anything that that you're aware of in this space?
I've heard of the issue with confessions of judgment, and I've heard it particularly in conjunction with merchant cash advance companies, that they get these in advance, and so the borrower is powerless to do anything about it once they do go to court, which is I think is also egregious. We're going to, our general counsel, John Helfat, is scheduled to testify this morning. He could perhaps give you more insight on that.
All right, thank you. Thank you, Madam Chair.
Sure.
Thank you, sir. Representative Delnicki.
Thank you, Madam Chair. Richard, you stated that, in essence, it's exceedingly difficult to try to come up with an APR on the front end. Could you, at the point in time when the borrower discharges the loan, it's all paid off, at that point, give them what the APR, effective APR was on that loan so that they know in the future whether that's something they want to do again or not?
I think that's a reasonable ask, because at that point we do have all the data elements and we could do a back calculation of what the borrower actually paid. So I hadn't considered that, but that's something that probably could be done.
Because I only bring that up from the standpoint that it could be a very good deal for the borrower, and it might not be, and they really don't know whether it's an effective. And it's not a question, Madam Chair. That's just an observation.
Well, to comment on that, it's the borrowers who enter into these facilities, these asset-based lending facilities or factoring facilities, typically work with our lenders for many years until they get to the point where they're significant enough that they would take on traditional unsecured bank loans. So the proof is in the repeat business that our members do with their clients, which we probably have some data we could show you on that too.
That would be helpful. But now my second question is pertaining to when do you call loans in default in a situation like this, or does that not happen?
Well, defaults are in our industry are less than 1% of the outstandings. And the reason is that I mentioned the fact that these are partnerships. The way the formulas are calculated for borrowing base, they're flexible, so that a lender will provide financing of up to 70% of somebody's accounts receivables or up to 60% of their inventory value. And if somebody is not in compliance on that, they have the ability to provide waivers. And in fact, that happens very frequently, is that these deals get restructured because ultimately we want to see these businesses succeed, and 99% of them do. And we do it by providing that kind of back and forth exchange and to make it work with that business's cycle or circumstances, which is, again, why it's so difficult to compute an APR in the beginning.
I'll have one more question, Madam Chair. So when you circle around, please call on me again.
Will do, sir. Are there any other questions from the members? Seeing none, sir, you may continue your questioning.
Thank you, Madam Chair. My last question pertains to the folks that do go into default. You said it was less than 1% or 1% or thereabouts.
Less than 1.
Well, less than 1. How are the lenders handled so that there's some kind of uniformity in the way people are protected and dealt with?
They're protected by the bankruptcy courts. Typically, a default is in the case of a company that needs to be restructured, and they can rely on Chapter 11 or Chapter 5 or Chapter 13 of the bankruptcy codes, and again, which are available to companies with revenues down to $2.5 million. And that's generally how these things get settled.
All right. Thank you for that answer, and thank you, Madam Chair.
Yeah. Thank you, sir. Are there any other questions from the committee members? Seeing none, thank you for joining us today with your testimony.
Thank you.
Senator, next we have John DiOrio.
Good morning, committee members. Thank you for the opportunity to speak today on Senate Bill 268, specifically the bond provision, which Matthew Smith spoke about earlier today. As it relates to the amount of the bond, I don't think that's a terribly pressing issue, except you should keep in mind that it will raise costs for Connecticut businesses. Just a consideration for you to spend some time on. But more importantly is the enforcement of 36A 492. We've done extensive research on the legislative history here, including several emails between legislators, OLR, LCO, and it appears as though the legislature wanted somebody to be able to cure a bond default before it happened, so long as they ceased the regulated activity. In other words, so long as they ceased the activity that required the insurance before the bond expired. It is not being enforced that way. And if the committee does not want cease doing business and surrender the license as a remedy for licensees, then they should remove that language from 492. And if they did intend, as it appears throughout all the legislative history, that was supposed to be and is supposed to be an appropriate remedy for a lender, then some clarifying language is necessary to make sure it does get enforced that way. The biggest problem with the way it's being enforced is enforcement actions under the Connecticut banking statutes are supposed to follow the procedures outlined in Chapter 54, the UAPA statutes, which is supposed to be the avenue for due process. The way that it's currently being enforced is in direct conflict with 4-182C, which is a provision within that chapter that provides certain protections for licensees. The way it's being enforced and the way the Supreme Court has interpreted it simply erases that due process under certain circumstances. I think the rest is adequately addressed in my written testimony. So if you have any questions, I'm happy to field them. And again, thank you very much for the opportunity to discuss the issue with you today.
Thank you, sir. Are there questions from the committee members? Seeing none, thank you very much for joining us today and sharing your testimony.
You're very welcome.
Thank you.
Senator, next we have Elizabeth Horton Schaaf.
Good morning.
Good morning.
How are you this morning, Senator?
Well, thank you.
I am blessed myself. Co-chairs and esteemed members of the Banking Committee, I come before you to speak on behalf of Raise Bill 5315, an act establishing a financial wellness trust center and authorizing the treasurer to establish a center for financial wellness. I am the director of community services at the Community Renewal Team. One of my creations over the past years has been the CRT Financial Literacy Institute. The Financial Literacy Institute is a 14-week program dedicated to providing financial literacy instruction and resources to participants of persons of all ages, all races, and cultures and economic status. Throughout the 11 years that our institute has been operating, we've had men and women in their teens, late teens to their early 70s who have come and participated in our institute. We talk about everything soup to nuts about financial literacy. And what I've learned over the years and have come to understand and appreciate that financial literacy and building financial capability personally, it deals with a mindset of how we go from poverty thinking to prosperity thinking. And so we work a lot with our institute students on the difference between needs and wants, the psychology of money, household budgeting, debt reduction, savings, and most importantly, credit, which I believe is our contemporary version of Jim Crow. But I just wanted to just leave you with a couple of words from our recent graduates. And this is a statement, I'm taking excerpts from the statement from Daniela Luna, who was our salutatorian in our class at our Financial Literacy Institute in 2021. She wrote, "One of my fears is financial instability. And throughout these weeks, I have been thinking about how my actions and values and which ones hurt me or help me. I think this class has taught me to analyze my habits truly and critically. I think this class has taught me a little bit about myself and the changes I need to make, like thinking about bigger picture and long-term rather than short-term. Overall, this class has helped me to try to learn more about myself, who I am in life, and what that says about my finances. If I learn about my values and beliefs and how that compares to all the class lessons, I am equipped to make the necessary changes to be financially successful. We all know that most of us have not received, and most of us still do not receive, any instructions on financial literacy, on how to manage your money. Our motto here at CRT is to have our customers, our student participants, learn that making their money work for them is a different mindset than just working for money. And I apologize for my phone going off like that. I'll throw it on the floor.
If you could please wrap up your comments.
I have wrapped up my comments, Dawn. I am available for questions now.
Thank you, Madam. So you are testifying on 5315. How would the Institute benefit from this fund?
Well, I'm understanding that there's a possibility that there would be funds available to help us run our institute. Right now, our institute is self-funded. We do not charge participants to attend, so we do this in kind. And if we had additional resources, we would be able to provide additional financial literacy resources to our students. And again, this is a 14-week program. Over the years, I think we've graduated over 100 participants, 100 students, because people get in there and they think, oh, this is going to be easy peasy. But when they get into this class and they realize that this is 14 weeks of really hard examination. They have homework assignments that must be done. We have quizzes, we blog with each other. I mean, like a Blackboard class you would have in a college Blackboard class. So it would be nice to have additional resources so that we can provide additional resources to our students, ma'am.
Do you currently have a waiting list, or do you maintain a waiting list for your institute?
We have people on, yes, a waiting list, and they know every year they start asking us about our institute runs from September to December. So every year we start getting inquiries about June, about the next class.
So with that being said, so June, you start getting your inquiries. So do you have to turn people away? That's what I'm trying to get at.
Yes, we do.
Okay.
We do have to turn people away. And because I think we try to do 20 slots. Last year we had 76 applications.
Thank you. Appreciate that.
You're
Representative
welcome.
Doucette.
Thank you, Madam Chair, and thank you, Ms. Sheff, for appearing before us today and for all of your good work over the years. I grew up in the area and have known your name. I know you've worn a lot of different hats over the years, and I appreciate everything you do for your community and for the whole state. And this is a good example of it. I think you're preaching to the choir to some degree about the benefit and the impact of good financial literacy programs. So I think we're all in agreement there. What I'd ask you is just for a picture of, I think we probably, as this bill advances forward, we may have to have some conversations with our colleagues to describe how this will actually look on the ground once it's implemented. So you talked a little bit about your program. I guess my question, if you could expand upon that a little bit about how it works. And then number two, are you in a position that you could actually go out in the community? What would this you think look like on the ground if you were to be able to expand it? Would you go into schools, or would you go into community groups, community centers? Is it something that could happen that way as you branch out?
Yes, Mr. Chairman. Financial Literacy Institute, again, is 14 weeks. So that's not really a transferable market. However, we do have a shorter condensed version called the 4 Pillars of Financial Literacy, which include household budgeting, debt reduction, credit, and savings. That is a marketable tool that we could take out into the community and have done so. So like I've done presentations at Asnunta Community College. I've done presentations at other nonprofit organizations who are looking to help persons who have very little or no financial literacy understanding to get a grasp of their finances. So yes, there's a way to tailor what we do to be marketable. Now, the Institute itself, like I said, is 14 weeks. We meet online once a week for 2.5 hours. And that's I could send you the curriculum, the syllabus we use if you would like to see it. That's a little bit more in depth than our 4 Pillars workshop. But the 4 Pillars workshop is something is mobile. We could do that anywhere.
That's great. Yeah. And I think that's important, to get to go to the people in the community that could benefit from this. The Institute is great as well, but I think what's exciting about this initiative is expanding the reach, growing the network and the opportunity for these programs to be out there in the community. So I think it's good stuff. So thank you again for your work, and thank you for your testimony today.
Thank you, Representative Duche. Yes, I'm a woman of many passions, and I try to act on every last one of them. So
that's great. Are there any other questions from the committee members? I have one last question. This is basically your thoughts. Treasurer Wood entitled the bill, part of the bill, financial wellness trust fund. And so do you have any thoughts on the importance of financial wellness in communities of color or low income communities?
Oh, yes. As I said, I work for the community renewal team, and we work with low income residents, right? And as the valedictorian noted, they're living paycheck to paycheck, sometimes not even paycheck to paycheck, just day to day. And one of the most important things that we could do for people who are meager means is to help them better manage what they have, and to help them prioritize and come to prioritize themselves, because you couldn't do it for them, Senator. I can't do it for them. They have to come to the realization of prioritizing what they have to address what they really need versus what they really want. So one of the things that we talk about in our class is the psychology of money, and how how we think about money makes us act, and how we think about not having money puts us in a deficit mode versus looking at the resources that we have. So working with folks to understand it's not about saving $1,000 a week. It's about learning to save. It's not about getting rid of your debt. It's, and it's about not building and reducing what you have. We're all going to have debt. That's a given. That's life, right? So trying to work with people to understand the bigger picture of financial capability, particularly people who have problems with credit, because as you know, nowadays credit, if you don't have good credit, then you might not be able to get that job, you might not be able to get that apartment, you might not be able to get your utilities turned on, you're going to pay more for insurance, you're going to pay more for goods and services. So trying to help people address credit is an extremely important part of financial capability. So it's a rough road because people don't really want to talk about money and they really don't want you to know about their situation. But in our Financial Literacy Institute, we've come to be able to bring people together and build a community that helps people trust our institution, help people trust the work we're trying to do, and therefore through that trust, build up confidence in themselves to be able to address their financial circumstances and better their future in that manner.
Thank you for that. And you used a word that I think is very important to this piece of legislation. That's the word community. Yep. That if everyone is financially well in the community, then the community is healthy.
Exactly, ma'am.
Flourish. So thank you for the work that you do, as Representative Doucette stated earlier, in all the arenas that you find yourself in. But thank you for the work that you've done for the people of this state. So are there no other questions? I want to thank you for joining us today and your thoughts on this bill.
Thank you, madam.
All right, thank you.
Take care.
Senator, next we have number 11, Jonathan Helfet.
Good morning. Can you hear me?
Yes, sir. Good morning.
Good morning. First, I want to thank the honorable senators and representatives for allowing us to speak. I'm Jonathan Helfat, and I am co-general counsel to the Secured Finance Network. And Mr. Gumbrick previously spoke and about our organization. He gave the background of the Secured Finance Network, and I will not dwell on that. We have submitted written remarks. I will not read those remarks. I would like to really just speak to two issues. The Secured Finance Network is opposed to the present iteration of 272. Our organization represents factoring companies and asset-based lending companies, and we believe there are two issues in the bill that deserve further examination by the committee. The first is the issue of disclosure. We already disclose. We disclose in writing to our prospective borrowers. We believe our disclosures are actually in greater detail than the requirements that are set forth in the proposed statute. So we think that we have already come within the strictures of disclosure. But the second and the rest of my remarks will be addressed to the issue of determining the true cost of financing. The proposed legislation uses a metric, APR, annual percentage rate, as a metric for our members to disclose to the prospective borrower how much they are going to be charged for the, quote, true cost of financing. Unfortunately, APR is a term loan metric. It is for term loans, not to be confused with what our clients do, which is open-ended revolving loans. So just as an example, and to just make the point, in a term loan, in closed-end financing, which is how the statute describes it, you know at the beginning of the loan how much you're going to borrow. You're going to get a mortgage for $200,000. The small business is going to borrow $50,000. APR requires you to start off, to do the APR calculation, you have to start off by knowing how much you're going to borrow. Then you can figure how much the interest rate is, whether there are any hidden costs, and you wind up with an APR. And it really works well for term loans. Our clients don't do term loans. They do open-ended commercial loans. So what it means is the currency of our loans are the borrowers or the small businesses' accounts receivable. On day one, when you meet with a prospect, the prospect doesn't know a year in advance how much their sales are going to be, how much they are actually going to need to a precise dollar amount. And therefore, you basically have to make some assumptions. The borrower will tell you, well, I think I'll do X. You have no way of knowing whether you think the borrower will do X. If it's a small business, it might not do the same as it did the prior year. And therefore, there's no way to know. So you make an assumption. That assumption's great, except if we're wrong, the statute wants us to pay a penalty if we're wrong. There's no such thing as a safe harbor. We're obviously going to be wrong because no borrower knows to the penny, no, even though large corporation knows to the penny how much they're going to have in collateral so that we can lend against it. So at the end of the day, the statute is taking commercial lenders who make open-end loans and putting them into a box where they're bound to be wrong, have to pay fines, and the borrower won't really even know the true cost of the financing. So we think,
sir, if you could wrap up, please.
yes, so we think the legislature should take that into consideration in reviewing 272. Thank you.
Thank you, sir. Are there questions from the committee members? Representative Doucette.
Thank you, Madam Chair. And Jonathan, Rich, I think told me to ask you this question, so I'll ask it now about what you see in the courts in this space. I mentioned the fact that it came to the attention of the committee that Connecticut is a favored venue for the ease of being able to get pre-judgment attachments, but Richard thinks that applies more to that the smaller merchant finance type of lending activity. Is that your understanding as well?
Yeah, in many merchant cash advance facilities, a requirement of the loan documentation is a confession of judgment. It is part of the paperwork. The loan documentation requires the small business to execute a confession of judgment. Our clients don't do that. Our clients do not ask for confessions of judgment. That is not part of our documentation. So yes, New York has recently changed its statute on confessions of judgment to make it only applicable to borrowers who are actually New York-based borrowers. Connecticut, you can take a confession of judgment and use it against a borrower who is out of state. So it is favored to come to Connecticut because there's a further reach to what a confession of judgment can be used for. And if you use Connecticut law in your documents, then that borrower could be in Indiana. Not so in New York. New York has now contracted the use of confessions of judgment.
Interesting. Okay. Well, I mean, that is sort of a broader issue that maybe outside the scope of this bill and this committee, but it's interesting to know and maybe something to bring up over on the other side of our virtual Zoom room here in the Judiciary Committee. But thank you. That's very helpful. Thank you, Madam Chair.
Thank you, sir. Are there questions from other members? Seeing none, thank you very much for joining us today, sir.
Thank you.
Senator, next we have Ryan Metcalf.
Good morning, sir.
Good morning, Senator. And thank you to the committee for the opportunity to address the committee and voice my support for SB 272. My name is Ryan Metcalf. I'm the head of public policy at Funding Circle. Funding Circle is the global online marketplace for small business financing that has helped over 120,000 small businesses access more than $18 billion since 2011. We are also members of the Innovative Lending Platform Association, who you heard from earlier. And we are also a member of the Responsible Business Lending Coalition, which is a coalition representing over 500 nonprofit community organizations for-profit small business financing companies, CDFIs, advocacy nonprofits, civil rights groups, chambers of commerce, and tens of thousands of small businesses. In 2015, the RBLC created the first cross-sector consensus on the rights that small business owners deserve and what financing providers, brokers, and lead generators can do to uphold those rights, called the Small Business Borrower Bill of Rights. In 2018, the RBLC helped pass the first in the nation commercial disclosure law in California. And 2 years later, the RBLC and ILPA came together to help pass the model commercial disclosure legislation in New York, called the New York State Small Business Truth in Lending Act. Since then, Congress, New Jersey, Maryland, Pennsylvania, North Carolina, and now Connecticut have introduced legislation that mirrors the New York law because it is the most comprehensive law in the country and because it has the support of industry, leading small business advocacy groups, for-profit and nonprofit lenders. It does not, however, have the support of some high-cost lenders because the legislation would require them to disclose to borrowers upfront the APR or estimated APR. In other words, disclosure of APR makes expensive products look expensive because they are. It is important to note that APR is but only one of several metrics disclosed to help borrowers make an informed decision, and nothing in this bill prohibits providers from disclosing other metrics. This legislation solves a fundamental problem in the commercial lending market, which is information symmetry in regards to pricing. The lack of information symmetry prohibits small business owners from being able to easily and readily compare the array of products, offers, and cost of financing. I'd like to thank the committee for introducing this legislation to protect Connecticut small businesses, create pricing symmetry in the market, and uniformity with other states, which makes it less costly for providers to implement. Thank you again for the opportunity to provide comments.
Thank you, sir. Are there questions from committee members? Representative Doucette.
Thank you. Thank you, Ryan. It's been a good discussion. I don't know if you've heard the others today that have testified on this or not, but one of the things that's come out, and the last speaker spoke to this, is sort of delineating against the types of different financing that might be covered in this bill, from the small business merchant lenders on all the way up to more sophisticated financing. You have any thoughts on that, and how we might want to, or if we want to potentially pare this down to not be quite as broad?
Thank you, Representative. The bill originally in New York was derived from information from the Federal Reserve. And when we looked at the data, merchant cash advance was the one product that we found, that the Federal Reserve found, that minority small business owners were using disproportionately more than others, and the smallest of small businesses. And one of the things that's really necessary is a small business is comparing merchant cash advance to a term loan, to credit cards, and they're trying to compare what's the cheapest option for their business. And so excluding certain products, we think, would be harmful to the small business borrower who's trying to compare in the market, because it is a marketplace. And so anytime we exclude them, I think that is to the detriment of the small business.
How about even a dollar amount or something like that? Again, to delineate against a large, multi-million-dollar, business that's got counsel and whatnot, as opposed to a truly small business looking for a cash advance or what have you.
I think in New York, I believe it's 5 million. I think in California, it might be 2 million. I can't recall, so don't quote me on that. But I think that's generally encompasses the majority of small businesses well below 100 employees, which is typically what the SBA would define as a small business.
Because I don't know if we do that. We kind of loosely base this off New York's law, but I don't know if we have that in this current draft. I'll have to review it again to see. But
to give you
thank you. And
a point of reference, for Funding Circle, our average business has 11 employees, but their average annual net revenue is in multi-million dollars. So you could be a truly small business and make at least $10 million in revenue. So revenue-based, I try not to do revenue-based, but I think the dollar size of the loan is appropriate.
Dollar size of the loan. Okay. Did you submit written testimony to us?
I have not, but I will.
Okay, that'd be great. Thank you.
Are there any other questions from the committee members? Seeing none, thank you for joining us today and sharing your thoughts.
Thank you.
Next, we have Sandra Diallo.
Can you hear me? Hello?
Yes, ma'am, we can hear you.
Oh, okay. I'm sorry, I'm not that tech savvy, but if you can hear me, that's good enough, I guess.
We can hear you, but we can't see you.
What do I push? Share screen?
No,
no.
On the bottom.
I should say some.
On the
Start
bottom of
video.
Start video.
Okay. Okay.
We got.
All right. Oh, okay. This is embarrassing. I don't know how to do this, but anyway. Just to let you know who I am, I'm Sandra Diallo. I'm a business owner of Body Secrets Day Spa and Hair Salon. I've been in business over 19 years. I'm also a veteran and a 72-year-old woman looking to eventually retire. What has happened to me? In 2018, I had a VA loan and the interest rates were going up and it was difficult to make my payments and keep my employees at the same time. I was trying to basically save my business. So I went to Key Bank for help and I was approached by this manager and she was really helpful, reached out to help me. So she said, well, we'll help you refinance your VA loan. And so which they did, they helped me refinance. But when I went to sign the papers, they went through the paperwork very quickly. So come to find out later on when after the pandemic and my employees left, and it was hard I had a 4,000 square foot condo building that I had bought, and it was down to 3 of us. So I decided, because of circumstances in my life, like I'm raising my 16-year-old granddaughter and my husband has contacted Parkinson's. So I thought it better for me to downsize and go into a smaller building. So with that being said, I reached out to Key Bank a couple of times and asked them what my payoff would be, but I never got an answer. So I just assumed that, things were fine. And so I went on ahead and put my building on the market. And come to find out at the end of the sale that Key Bank charged me a pre-penalty fee of $52,000. And I was shocked because that was never explained to me in the signing of the documents. So at this point, all I can say is, I hope that, this committee would make a bill so that doesn't happen to anyone else, because to me, I was kind of like hoping to have a little bit of money saved for the situation that I'm in, but it is what it is. And I just hope that, that banks are more accountable to explaining to people about what's in their loan packages. Because when I read mine and I read it as that they were just going to take the interest rate of my last payment. That's all I could understand out of that. And then finally, I guess when my my attorney that did my closing, he explained it to me, and I was really shocked. So I had no idea this was going to happen to me. And if I had known that, I probably would have done something else. like maybe rent out my salon or do something else, because that, to me, $52,000 is a lot of money. So
if we could ask you to wrap up, please.
That's pretty much what I want to say.
Thank you, madam. And I am so sorry that you had to go through that experience. And, you know, that's one of the first things, in my opinion, that banks should explain to individuals. What is the prepayment? Is there a prepayment penalty, right? And so, but I truly apologize that you had to experience that on top of what was happening in your personal life.
Well, the other thing that I'd like to say, but I knew in my VA loan, my VA loan was just very specific, and anybody could read it. And there was like a 1%, 2%, 3% penalty, prepay penalty fee. So I understood that. But in this document, there is no percentage, there's nothing. It's just a lot of words that, you know, most people won't understand.
Mm-hmm. Thank you. Representative Doucette.
Thank you, Madam Chair, and thank you, Sandy, so much for coming forward. We talked a couple of times. You brought this issue to my attention, and I know you probably didn't set out in your career and selling your business to be, you know, bringing legislation forward to the banking committee. But I so appreciate you, because it's so important. And your story, you said 52,000 to you, 52,000 to almost anybody I know is so significant. It's just staggering. And your story, I think, illustrates that we really need to do something better. And we really need to have banks do something better in disclosing these fees. I don't know if we talked about this, but I've been an attorney for over 20 years, doing these types of lending transactions, and I got to tell you, I think those prepayment penalty calculations that appear in the promissory notes are confusing. I have to read it 10 or 11 times to make heads or tails of it. And you've illustrated that, obviously the average person, has a hard time with it as well. And your attorney, has to go through it, so this is an area that I think we can do better, and we need to do better. And I think this proposal is to have just sort of a plain explanation with actual dollar figures of what that prepayment penalty would be. Because as you said, and this is the kicker, if you had seen that or known that, you would have thought and probably not gone ahead with this particular type of loan or refinancing. So that's so important, that if others can save themselves the anguish and the money of having to go through something like this, then I think it's so important. So again, thank you for coming forward. Just one question again, could you tell us exactly how much the loan amount was? We know it's 52,000 prepayment penalty. How much was the actual loan amount that you originally had or refinanced?
Oh, I'm sorry, I don't have that in front of me. My brain is so messed up. I don't have that in front of me.
You had reached out, it was something in around 200,000 or just between 200 and 300,000, I think, right?
Yeah. Yes.
So
something like that. Yeah.
I mean, a $52,000 prepayment penalty on a loan of somewhere in the 200s is just exorbitant. I think we all can agree. So again, thank you for coming forward. So appreciate it. It's gonna help others. So
right.
So thanks very much.
And thank you.
Thank you, madam. And thank you, Representative Doucette, for bringing this bill forth. We appreciate it, because as you stated, it will help other individuals in the state. Are there any other questions from committee members? Seeing none, thank you again, madam, for coming before us today.
You're welcome. Thank you.
Senator, next we have number 14, Bill Marone.
Good morning, sir.
Good morning, and thank you, Dawn. You actually pronounced my name right, which does not happen to my kids when they go to school very often, so I appreciate it. Honorable co-chair, Senator Miller, Representative Doucette, ranking members, and esteemed members of the committee. I'm here to offer testimony in support of Senate Bill 270, which would seek to promulgate repossession notices. I've submitted written testimony on behalf of the bill and in support of the bill, and don't want to just regurgitate what's there. The committee can feel free to review it. I make myself open and available at any time to discuss it. Two things from today's hearing made me very happy. One was something I heard, and one was something I didn't hear. So the first thing I heard was not something I intended to testify on, but I can't let it slide by without saying that as president of the Connecticut Creditor Bar Association, we would support the Treasurer's Bill, House Bill 5315. We have put together, and I've actually personally taught a financial literacy class called Avoiding the Debt Trap. And I can't speak to how important that piece is, especially at the formative years before you go. There's no other space where on-the-job training is more hurtful to your professional life. And I can say that as somebody who misused his first $500 credit card as I put myself through college. So I personally understand and support it. So I appreciate the committee's strong consideration of that bill. The second thing that made me happy was what I didn't hear, and it was what I did not hear from Matt Smith. What I did not hear was, I've been monitoring last week's hearings, and I'm very well aware of the sort of the bandwidth issues over at the Department of Banking in certain spaces. So what I was happy not to hear from him was his concern about implementation of Senate Bill 270. It was something that I had a concern about because I had not had direct contact with them. I think the speaker after me, Bruce Adams, will speak to potentially some of his personal experiences in this space. But one of the things that we would like to continue to work with the committee on is creating some substantially similar language and things of that nature to give both Department of Banking some implementation burden easing, and then to give creditors of all sizes a little bit of flexibility in how they implement the notices, because as you know, resources vary greatly across different sized institutions. So other than that, I will cede any of the rest of my time to any questions anybody has. And I appreciate the work of the committee.
Thank you, sir. Are there questions from members of the committee? Seeing none, thank you for joining us today and sharing your thoughts.
Thank you very much.
Next, we have number 15, Bruce Adams.
Good morning, afternoon.
No, it's still morning.
Okay.
Good morning.
I'm on the cusp of it. So, thank you, Chair Miller and Representative Doucette and all the distinguished members of this committee. My name is Bruce Adams, and I'm the president and CEO of the Credit Union League of Connecticut. And I'm testifying today in support of two bills, Senate Bill 270, an act concerning repossession notices, and House Bill 5315, creating the Financial Wellness Trust Fund. Beginning with Senate Bill 270, as I say often when I testify in front of this committee, I like to remind them about the unique purpose and structure of credit unions. We do offer a unique benefit to the consumer of financial services, and they can offer the same products such as checking and savings accounts and home mortgages and vehicle loans, but we also return our profits made, if any, back into our members in the form of advantageous rates on deposits and loans. Upon a consultation with Attorney Marone, who, as you just heard from, we support this bill regarding repossession notices for the following reasons. When a borrower does default on the loan and the lender must repossess the vehicle, the lender has to provide the borrower with a notice of repossession, and the form and manner of those notices is not currently prescribed adequately by law. and that presents a litigation risk to the otherwise well-intentioned lender. So simply put, the lender deserves a safe harbor, the comfort of a safe harbor when it delivers a substantially complete and proper notice to the defaulting borrower. And this is especially important for credit unions on the smaller side of the asset spectrum, because they don't have the same access to legal counsel and compliance resources to make sure that they've dotted, absolutely every I and crossed every T with respect to the very technical requirements of providing certain notices. And in this case, if the lender is able to provide such a notice that is substantially similar and certainly substantially complete to the borrower, we don't think that the lender should have an unnecessary risk due to a technical violation. With respect to the other aspect of this bill, as many of you know, I've served in the executive branch for many years in the Department of Banking as general counsel and in Governor Malloy's legal office, working with many of the financially related agencies. And in the course of that service, I have seen how technical prescriptions in statute have hung up people who are trying to comply but can't or don't for some minor technical reason. And for that reason, I think that that the substantially similar aspect of this bill ought to be spelled out clearly. Moving on to the Treasurer's bill regarding the Financial Wellness Trust Fund, we were big supporters, the credit unions were, of establishing the Baby Bonds program, which contained a financial literacy component to it. And our national organization of credit unions has embarked on a big initiative called Financial Wellbeing for All. And financial well-being is an important concept because it not only has an objective component to it, which is whether a person is actually secure in their financial life, but whether they feel the comfort of their financial position. And any efforts a state can engage in to help people both understand what to do about money and help them figure out how to feel about money will, in the long run, lead to better financial decision-making and, frankly, shore up the resiliency of our state's economy. So for those reasons, we support both of these bills, and I'm happy to entertain any questions.
Thank you, sir. Are there questions from committee members? Seeing none, thank you for joining us today, Mr. Adams.
Thank you.
Okay, now we have number 16, Art Corey.
Good morning, co-chairs Miller and Doucette, ranking members.
Mr. Corey, would you like your cohort also in the room at the same time?
Mr. Mongello, sure, why not?
Okay, please admit. Thank you.
I'm going to call him cohort, my cohort now. Well, good morning, everyone. What's that? It's
sidekick.
There you go. Okay. It's good to be with you again today to speak about just a few bills. The first I'd like to speak to is Senate Bill 269, which would allow a financial institution to decline, delay a transaction or place a hold on an account if the financial institution had a reasonable cause to believe, that part's in the statute, that a transaction or an account involves exploitation of an elderly person or a customer. The authority to take this kind of action lasts for 15 business days, so it's temporary, from the date the financial institution first takes some kind of action to help put a hold on a transaction to help protect the customer. But that time is shortened if the financial institution is satisfied that no exploitation is occurring, or a court issues an order terminating the bank's authority to do that. A bank can extend a hold for another 15 days under certain circumstances where they've established essentially that exploitation is occurring or continuing to occur. The ability to delay a transaction or put a hold on an account for a limited period of time will give banks a much needed tool to help stop instances of elder financial exploitation. It gives them the time to reach out to protective services for the elderly, for example, law enforcement, or even a trusted person, such as a family member, a person with a power of attorney, et cetera, to alert them to the exploitation and to hopefully help stop it. Our CEO, Tom Mangiello, will follow me and have some other comments about the importance of this bill. I'd like to next move to Senate Bill 272, which would require lenders to provide certain disclosures to borrowers before making a small business loan, those loans that are $500,000 or less, which would include disclosures about finance charges and interest rates, et cetera. The bill exempts financial institutions, but not their affiliates. Like banks, affiliates of banks are highly regulated and examined by regulators, and therefore we think they also should be included in that exemption. Finally, I'd like to talk about House Bill 5317. This bill would give the Attorney General the authority to issue investigative subpoenas when the Attorney General has reason to believe that a person has violated any provision of the federal Dodd-Frank Act, which has a number of consumer protection provisions in it. We have a few concerns with this bill, particularly around its broad scope, but the Attorney General's office did reach out to us, thankfully, and we appreciate that, for our thoughts, and we've agreed to work with them on this bill to try to address the concerns that we have. So again, I'd like to thank you for the opportunity to share my thoughts today on our thoughts on these bills, and happy to take any questions.
Before we go to his cohort, are there any questions from the committee members? If not, Ms. Mangiello, how are you today? Thank you for joining us.
Thank you. Thank you. It's good to see everyone. And thanks to the chairs and the members of the committee for the opportunity to testify today. Before I talk about Senate Bill 269, it was great to hear from the treasurer this morning. And we joined Bruce Adams and Mr. Marone in their support of House Bill 5315. Almost all our banks have financial literacy programs in some form or another. And it is one of the key goals that we have is to get financial literacy across the state of Connecticut, quite frankly, from middle school on up. So thank you for bringing that bill up, and we are supportive of it. Getting on to Senate Bill 269, which Art just talked about. You heard the particulars of the bill from Art. I'm here to mention some important actions, considerations, and goals that all banks have in protecting some of our most vulnerable customers, the elderly. Before I do that, I'd like to level set on what's commonly called elder financial abuse. It targets adults over the age of 60, and particularly those that might have dementia, underlying medical conditions, or no children or family in the area. Older adults can be defrauded by strangers, family members, business associates, even caregivers. Those frauds might include unauthorized use of bank accounts, other financial assets like stocks and investments. It might be getting a power of attorney assigned through false pretenses or automatic withdrawals into a fake account. Warning signs can include rapid drawdowns of bank accounts, unusual or increased account activity, new accounts opened up without the customer's knowledge, and recent revisions to key personal documents like wills, mortgages, trusts, or deeds. Now let's get back to the actions and considerations that bankers take to protect older customers. I'll start with those bankers that are on the front line of identifying potential fraud, are customer-facing employees. That typically includes tellers, customer service representatives, and branch managers. All these team members must complete an anti-elderly fraud training program within the first 6 months of being hired. That training gives those bankers key information on how to identify and take allowable actions to protect our older customers and their money. Those bankers use detailed and well-practiced procedures if a fraud is suspected or identified. And those may include contacting the Protective Services Division of DSS, calling local or state law enforcement, reaching out to known family members, or to the older customer's professional advisors, such as their accountant or their attorney. But in many clear-cut fraud situations, these actions have to be taken after the money has been delivered to the elder customer and after they've given it to the fraudsters. That's because the customer, if they insist on taking out the money, we must deliver it to them. It's these situations that this bill would give us the ability to address. And the bill would allow us to do that by putting a temporary hold on that transaction so that the key steps I mentioned can be carried out and really to find out, is that transaction legitimate or not? If it is legitimate, what's the harm in protecting the customer's dollars for a relatively short period of time to verify it versus allowing the elderly customer to be robbed? Usually there's no harm in holding that out for a few days. That's borne out, by the way, by 16 other states that have similar laws. As Art mentioned, we look forward to working with Mr. Lang, who testified before, the Bar Association Elder Section, who I believe is going to be testifying after us, to make this bill better and to address some of their concerns. However, now is the time to take action on this important concept. There's already been too many elder fraud victims, and this bill would provide a critical tool to stop older customers from being financially ruined, quite frankly. We'd kindly ask the committee to support Senate Bill 269, move it forward in the process, and thank you again for raising this important concept. I'd be happy to answer any questions through you, Madam Chair.
Thank you. Are there questions from the committee? Representative Doucette.
Thank you, Madam Chair. Good afternoon, gentlemen. You may have heard we did have the testimony from Mr. Lang. There's a lot of concerns, a good number of varied concerns from the elder law attorneys who have looked at this. Wanted to give you an opportunity to maybe respond to some of those. Certainly, there was an offer to continue to work on this, which I'm sure we all would take them up on and would look forward to having those continued discussions. But right off the bat, are there some things that you think could be addressed in some substitute language or modifications to the existing language that might address some of their concerns?
Sure. So that's the first time we've actually heard verbally, obviously, in his testimony what some of the concerns are. Art's our legal mind here, so he might have some better comments that I could have, but we're certainly willing to work with them. I will note that the concept that's going to be brought up by the Bar Association about using the probate judge system, I think is novel. It's something that we haven't seen before. Quite frankly, we haven't thought about it, and that could essentially provide a much quicker process than having to essentially go through the Superior Court process. But all the issues that Mr. Lang brought up, we would certainly be more than willing to talk with him, obviously his organization, and also with the Bar Association. Art, did you have any particular comments about what was brought up by Mr. Lang?
No, well, I'll just there. He did mention a few things, for instance, and in his written testimony as well, a remedy. I think for if a bank got it wrong, I guess that there be some kind of remedy that the customer have against the bank. That's something that we'd be concerned about. Obviously, banks are not doing this with any self-interest, if you will. They're trying to protect their customer, and I guess maybe if there is a self-interest there, it's to protect themselves as well, because oftentimes when the money's all gone and it's realized by other persons in the elderly person's lives, then the bank is the first that would be looked to make the person whole. So being able, having the risk of liability for taking these actions to help protect the customer could have a chilling effect on what we're trying to do here, which is to allow banks to use their judgment. And I'll say that in my experience as a lawyer representing a lot of banks who experience this on a weekly basis, at least the calls that I dealt with from my clients, they always got it right. They know it when they see it, and they weren't using whatever tools that they may have. And sometimes it was taking a risk. It was putting a hold on a transaction, and we would talk through that as to whether that was appropriate or not. And when it was absolutely abundantly clear, which it almost always was, then we would take that risk and put that hold on that transaction while we tried to get somebody to, like Protective Services, to do something about it. So, we don't want to have that chilling effect. I think the banks almost always get this right. We've mentioned before, they have to take training within the first 6 months of their employment on this, and banks always, of course, do ongoing training on this. Mr. Lang in the testimony also mentioned notice to the customer. about these things. He's right. There's no notice that's required to provide to the customer. We can certainly, I think, work on that as well. That's a place we could work. But as a matter of practice, there's always a notice or some kind of communication to the customer saying, hey, we're doing this because, we think that this is fraud. So, and then I think there are a few other areas where we probably can work, and we'd certainly love to entertain any specific language changes or provisions that they'd like to suggest.
Yeah, that's good. And I think, yeah, you illustrate a few areas there that I think we could improve this. And, as an attorney, I loathe to say this and maybe offend the fellow attorneys that we don't want to go to court all the time in cases like this, either beforehand or after the fact. To the extent that we could create some process and procedures that would help and get us to where I think we want to be, and balance all the interests, of the, trying to be expeditious with the transactions and also protect the elderly. I think that would be a good place to be. A second question, super quick one. Art, you mentioned on 272 the $500,000 threshold, which I appreciate that because I was searching for that, and it's in the definition of provider. So we're effectively basically this 272 is only dealing with transactions less than 500,000. Is that your reading of it as well?
That's how I read it, and I think this is pretty similar to the bill that was raised in the committee last year, and I think that's the same. So yeah, that's how I read it.
Okay, good. No, thank you for highlighting that. All right, that's it. Thank you, Madam Chair.
Thank you. And I just want to piggyback on Representative Doucette in that I would appreciate if you would work with the elder law attorneys, because Attorney Lang made some very good points about the unintended consequences if there are automatic deductions. And I can imagine if your mortgage is the automatic deduction and you've frozen the bank account and the joint account, and so those are things that although you're trying to protect the elderly, there may be unintended consequences. So if you could work with them to kind of iron that out, as my co-chair stated, attorney, no one wants to go to court, and so I have been where my account was frozen and due to a joint account, and everything of mine just bounced. And so it's if you could work that out, it would save a lot of headaches and anxiety for the other parties, the parties involved. So thank you very much. Senator Bertho.
Thank you. Excuse me. Thank you, Madam Chair. Tom, Art, thank you as always for providing the committee with some industry perspective. I think as we just witnessed for the last few minutes preceding or following your testimony, that you have given us, you provoked some good questions and brought forth some ideas and things we need to perhaps just tweak a bit in the bill going forward. So that's very helpful. And as always, we appreciate seeing you here when we're bringing forth what ultimately is good legislation for the financial industry in Connecticut. So thank you.
Thank you.
Thank you, Senator. Representative Paolello.
Thank you, Madam Chair, for the opportunity. Tom and Art, thank you very much for your testimony here. I wanted to follow up on a couple points that you both raised around continuing education around employees. You mentioned, early on, folks have to take a course, but how is it on a go forward basis? What is the training like, and what's the time period in intervals? Is it every year or every couple of years that additional senior training for dealing with seniors, for dealing with families is provided to the frontline employees and employees that are dealing with the accounts every day, establishing the accounts, servicing the accounts, doing the face-to-face meetings? How often is that training, and what are folks required to do?
Sure, that's a great question. Off the top of my head, we haven't surveyed the banks as to how often they're doing this. We certainly could ask them and get back to you with that information. We know that we have continuing education, across the board, including in this. And I think it really does depend on the bank itself. It would probably also depend a little bit about what the marketplace was, where the branch was located. Is there a senior population around there that would require more additional training, or I should say more frequent training? But we'll definitely look into that for you, Representative, and that was a good question.
Yeah,
I would just add, banks are required to file what are called suspicious activity reports with the federal government when they see a crime being committed. And elder financial exploitation is actually one of the highest reported crimes for these suspicious activity reports. And so because there are severe penalties for not reporting crimes when they occur or suspected crimes when they occur, banks do a lot of training to help with their frontline staff to ensure that they can identify these crimes. And as I said, elder financial exploitation being one of the most prevalent on this reporting, they by necessity have to do a lot of training in that area.
Yeah, Art, that's also a good point about, these BSA reports that we have to do, suspicious activity reports. That's critical for us from a training perspective, because if a bank employee gets it wrong, there's actually criminal penalties associated with it, because we're talking about money laundering, things of that nature. So that's a great point, Art. Thank you.
If I could just follow up along that line of questioning around, if a frontline employee, comes across a situation where they may feel, there may be outside interference, family member, someone else, looking to take advantage there. Do banks, as some financial institutions have a compliance unit that just deals with elderly issues, for instance, where that frontline worker can call, can make a report immediately, can start, moving up the chain in an institution to protect the elderly, to protect the family, to protect them from someone that may be taking advantage of them. Do banks have those units set up on a corporate basis where, that frontline employee can go and reach out for both advice, to report the incident, and to kind of have a follow-up so that, that individual, that senior, is not taken advantage of?
Sure. That's another great question. It really is dependent on the size of the institution. A small institution is not going to have a unit devoted to that. That's quite frankly why this training is so important on a regular basis. However, once you get to the larger institution, especially like money center banks, things of that nature, you will have units which are specifically addressing fraud issues, probably more of a collective fraud situation. It could be anything. It could be identity theft. It could be elderly fraud, because elderly fraud is just one of many. So I think by and large, the larger institutions would probably have a unit or a department, as you said, that would essentially take a close look at any fraud that's being impacted upon the bank and the customers, obviously, and the policies and procedures that are in place to deal with that. And let's not forget, this is a very sensitive information when you've got an older person who's coming in who wants to withdraw their money, and you're asking them very delicately, why are you taking $5,000 out in a paper bag and giving it to somebody who's across the street? So it is a delicate situation, and because these are our customers, customers react differently, obviously, but that's where the whole concept of this bill being able to essentially put that temporary hold on gives us that ability to reach out to all those folks that you were just talking about, Representative. So you're right on track as far as what we're thinking, as far as what a solution would be.
Thank you for that. If I could just go down one other line of questioning, in terms of when seniors set up accounts, or maybe make different movements, money movements, or establish, set up a new CD, for instance, is there an ability for folks to name like a trusted contact, or someone that would be alerted on the account, or say a renewal is coming up for a CD, and they don't respond, and the correspondence can be directed also to that trusted contact, or if there's an address change, or if they're changing their online access, or to have electronic statements sent to them, that trusted contact that they named would be alerted if there's no action taken, or if there was a change made on the account, so that third party is kind of kept in the loop. Do seniors have that opportunity generally to be able to have another level of protection there?
I'm going to ask our deposit account expert to address that question.
Yeah, thanks, Representative Palillo. So that's usually done through a power of attorney that the elderly person would give to someone. It's not typical for a financial institution in the account documentation to say, for where the customer could say, I'd like you to, provide any information to this person over here. And I think there's a number of reasons why banks don't do that, privacy concerns, and things like that. But so yeah, it's typically through a power of attorney that, or sometimes you see an elderly person put somebody on as a joint owner, just as a matter of convenience, so that they could talk to the bank, and get over that privacy law hurdle, but also usually to help them perform transactions. So that's kind of how that happens, that your concern gets addressed. Yeah.
Because I know some financial institutions will have that trusted contact be able to be named, for the establishment of maybe, insurance policies to prevent them from lapsing, or health insurance, again, to prevent them from lapsing or not having that coverage continue. So it's certainly something that I'd like to continue to talk about. And then around just transparency with statements.
Excuse me, Representative, can you hold your questions so I can see if there are other members that would like to ask ask questions? So thank you. I'm sorry, I'll circle back to you if there isn't anyone. Is there anyone that would like to ask questions? Okay, sir, you may continue.
Okay, thank you, Madam Chair, for the opportunity. I'll wrap it up. So my last point around statements, and a lot of seniors don't have the ability to log on, to check electronically, or don't have the capacity, or don't want to do it to begin with. And so paper statements are extremely important. And there are financial institutions sometimes that, if, folks don't request it, then they don't get the statements because it's the responsibility, with retirement plans or with IRAs or other different types of an account. If they don't go online, then they don't get that statement in the mail. And I just think that level of having statements come to them just creates another level of transparency. If there were movements in and out of the account, if there were withdrawals, if there was action taken. So I just don't know what the policies are overall for folks to be able to, if they don't have online access, to be able to receive those statements on a regular basis, whether it's monthly or quarterly, again, to create that transparency and to kind of ease their minds that they have what they have and that they're able to follow on a pretty regular basis.
Sure, absolutely. I think we're going to tag team that if that's okay. At any rate, different accounts have different features associated with them. And some of those features, like for instance, if you have an online account where you don't have any fees associated with it, that includes basically doing everything electronically. So I think what you're really addressing here is the suitability of the account for the older customer. If that customer feels the need to essentially have those statements coming to them, that's usually addressed at the account opening or during a visit to the branch, which is very common with our older population. With that said, there are rules and everything else that we have to abide by. I'll flip it over to Mr. Corey at this point to go into a few more details on how that process works.
Sure. Thanks, Representative. So the both federal and state law requires any bank that wants to send somebody electronic statements to first get the deposit customer's consent to that. So that you can't get electronic statements sent to yourself unless you go through a process where you electronically consent to that. And even if you do consent to that, you can withdraw your consent at any time during the relationship with the bank and get paper statements, mailed to you again, or to even request a single paper statement. So, any bank that's not following those rules ought to be, because that's how it works at this point anyway, both on the federal and state level.
Sure. Does that also extend to your affiliates? That may be utilizing investments or broker dealers that are coming in to banks that may be offering other products, annuities, mutual funds. what have you, that people may be funding, retirement accounts with those products being offered under your branches and your branches under your roofs?
So as Tom mentioned, it kind of depends on the product and the document, but the law is that if there's any law that talks about or requires a consumer disclosure, then it can't be electronic unless the customer consents. So that would apply outside of banks to affiliates like investment advisors, broker dealers, if what they're sending to them is a required disclosure. So the statements that you mentioned, there are rules about what's in those statements, the disclosures that are in those statements. And because there are rules, this law that I talked about applies. And so it has to be offered, paper has to be offered. So if they're sending just a marketing piece, that's not a required disclosure. So they could send that to them electronically, without the consumer's consent. Well, there are other rules about that as well. But my point is this rule that I talked about applies to disclosures that are required by law. So, and the paper statement would I don't know on the investment advisor side, if the statements that they send, I'd have to take a look at this, fall into this category. There would have to, again, be a law that says, here's what has to be in those investment advisor disclosures. So it may very well be that there is that kind of rule, in which case this paper statement rule would apply. I can follow up with you on that as well.
Sure, I would appreciate it. My concern there, obviously, is as we deal with seniors quite a bit, and both as constituents and in our other work throughout the course of a day, is that most folks, sometimes as seniors don't want to go online, and sometimes, companies, financial service companies, do not get those statements to them, and I just think there's a level of transparency that's missed by folks not being able to regularly look at the statements, track their investments, see what's going on with their accounts. And I think it's important for both sides for a level of transparency, so that later on no one is explaining what might have happened to a statement, or why there was a distribution made, or why someone might have to close an account, for instance. So I'd certainly be happy to continue to have that conversation. But I think it's important, the more level of contact, the higher level of contact, consistent contact, certainly keeps everyone in the loop and protects the people that we want to protect most, seniors and folks around us. So thank you for the ability to ask the questions today, and thank you for your thoughtful answers and your information.
Thank you.
Thank you, Representative, and I couldn't agree with you more. Are there any other questions from the committee members? Seeing none, thank you, tag team, for joining us today. We appreciate it.
Thank you.
Thank you.
Next, we have number 18, Joan Nichols.
Thank you. Good afternoon, everybody.
Good afternoon.
Thank you. Senator Miller, Representative Doucette, and members of the Banking Committee. My name is Joan Nichols. I'm the Executive Director, Connecticut Farm Bureau Association. Today, I'm asking for your support of House Bill 5316. Farmers are self-employed with a substantial amount of their assets accrued in land, equipment, and infrastructure. Available capital is often reinvested in the farming operation. Crop failure, catastrophic weather events, crop or livestock disease or pest, periodic times when production costs exceed farm income, labor shortages, fluctuations in commodity prices, illness or injury, equipment failure are just some of the many challenges our Connecticut farmers face. These challenges can make it difficult for our farmers to have the extra financial resources to invest in retirement savings accounts. HB 5316 provides a sound financial option for farmers to contribute to a retirement savings account. Similar in concept to a 529 college savings account, this voluntary program will help incentivize our farmers to set aside money in a dedicated investment account for their retirement. The committee should be aware that over the next 10 to 20 years, the demographics of our farmers, issues going on with farm transition planning, family dynamics, consolidation of farms, we're going to see an unprecedented amount of farm businesses and farmland transitioning in the state of Connecticut. This is another financial instrument to assist with farm transition planning and the protection of our Connecticut family farms. Having dedicated funds available for farmer retirement helps ensure our farmland and farms are not sold to raise funds for retirement. A farmer's retirement savings trust afforded by the passage of HB 5316 is a worthwhile investment in sustaining the future of Connecticut agriculture. Connecticut Farm Bureau urges the passage of this bill, and I'm happy to answer any questions. Thank you so much for your time.
Thank you, Joan. Thank you for your testimony. I'm going to step in for Senator Miller. I think I had to go to another meeting for a little while, so I will be at the helm now, and I will recognize Representative Delnicki, who has his hand up for a question, I believe.
Thank you, Mr. Chair. And Joan, thank you for coming forward with this. You know,
You're welcome.
It seems like farming is an endangered species in Connecticut. And the family farm, which at one point in time was the heart and soul of central Connecticut and virtually the entire state. And I've talked to numerous farmers that find themselves in the predicament of the children don't want to take it over because it's a tough life, and they see their parents are there and they're dedicating all their time to it. What do you think that this will mean to the average family farmer and farm, and how will this perpetuate continuing farming in our state? Because, you know, locally grown agriculture is some of the best stuff you're gonna find.
So thank you, Representative, and thank you for bringing up those questions. Challenging is farming. Farming is challenging. We always like to say it was that easy, everybody'd be doing it. What this bill does is provide another instrument for our farmers to save for their retirement years. Farm transition planning is a very, very, very complicated issue. As you alluded to, there's family dynamics, there's finances involved, there are people that want part of the farm, people that want the money from the farm but don't want the farm, and you have multiple generations on the farm. It's very, very, very complicated, and far more than I could take up in the time allotted to this committee in this hearing. What this does is it's like any other, what I would look at is any other incentive for a family or an individual to invest in their future financial soundness, so to speak. No different than a 529. When we created those, I had one for my children when they were young to save for college. It was great. It sort of gave you the instrument that kind of forced you a little bit to take that little extra money and set it aside for the future when your children were hoping to attend college. Served my children very well. I think this is similar. It's not the be-all, end-all to save the family farm, but it's certainly a sound financial tool that our farmers, like I say, voluntarily could contribute to. And I think anytime that you provide an incentive for individuals to invest in their future, just like the college savings plans, I think it benefits many of us. And this could help. Thank you.
You know, every time I see a farmer sell their property for it to become a subdivision, I see it as a loss to the state because of just how important local agriculture is. South Windsor had a fantastic base of agriculture years ago. We still have a great base of agriculture on Old Main Street. But I worry about those folks reaching that point where they sell the property for subdivisions. And if this can help farmers to make that choice to not sell and to have something that they can hand off to their children while having money in the bank to cover their retirement, because you wouldn't be amazed, but folks would be amazed at the ages of the farmers and how farming is graying out. And any way that we can make it more attractive for the younger folks to go in and take the family farm over and keep it going would be a great thing. Now, how do you see this working for the average farmer?
Again, this is a somewhat new concept, but I think the premise behind it is well worth passing this bill. And again, just like any other financial tool or instrument that helps families plan for the future is good. How many farmers will take advantage of it because it is a voluntary program remains to be seen. But I think if we don't provide them with that opportunity, we'll never know the benefit of it. So just like farmland preservation, just like a whole host of other tools that get put into the farm family's toolbox to help sustain the farm, keep it for the next generation, provide some financial solvency so that they can continue to keep the farms that you've spoken so passionately about, Representative, I think is anything that we can help. The demographics is, I think the average age of our farmer now is pushing 60 based on the USDA Ag Census. And that's why I referred to the fact that over the next 10 to 20 years, we're going to see a dramatic shift in the demographics, shifting of who owns our farmland and who's farming in the state of Connecticut. And we need to give them every available financial resource out there to help them plan for the future of their farms. So I appreciate your passion and comments.
Again, I thank you for coming forward to testify on this, and quite frankly, anything we can do to keep the family farm in the family, I think, is a good idea. Thank you, Mr. Chair.
Thanks, Rep. Delnicki. Anyone else? Any other questions for Joan? Seeing none, Joan, I want to thank you. I did actually have one additional question that came up while I was listening to this conversation, which, by the way, I think, in terms of the succession planning, the preservation of family farms and of farming in general, not losing to subdivisions is really interesting, really compelling reason to do something like this. But my question is, what is the size of the current farm workforce in the state of Connecticut, roughly? Do you have any information on that?
The last, any amount of, I'd have to look at the last USDA Ag Census. I wasn't really prepared to answer that question. When the Yukon updated their economic impact study to Connecticut agriculture, I think it was updated in September of 2017. So it's certainly a little bit dated, but I think relevant. At the time, they looked at our workforce as about 20,000 in the state of Connecticut. The labor issue is a whole other issue, which again is another reason why these financial tools are important. We're experiencing, probably like any other business sector in the state and actually across the country, is an acute shortage of both skilled and unskilled labor in the agricultural workforce. And that's a whole other conversation that, we could sit down around the lunch table and try to find solutions, and that's a whole other problem. But it's substantial. And of course, the nature of agriculture is there's seasonal ebbs and flows in the workforce, as you can imagine. Our biggest farms in the state, our poultry industry and our dairy farms and the big nurseries we have, not unusual for any of those farms that need workers all year long to have 300-400 employees on each one of those farms. The seasonal nature of the farms is oftentimes they may have 20 or 30 full-time workers, and then their workforce increases to 200 to 300 during the height of the growing season.
Right. That's what I figured. But it's good. It's good to have those numbers. And as you probably know, the next step for this bill, if we report it out, is one of the next steps is the Office of Fiscal Analysis is going to look at it and try to determine what we're talking about here in terms of a fiscal impact. So it's tough, as it is in many cases, to estimate that for something like this. But it's good to know, and would certainly may reach out to you again if you do have any information you want to share with us that we could then share with OFA as they're trying to come up with those figures. That would be helpful.
Sure. I did submit my testimony, and my contact information is on the testimony, and I certainly welcome the opportunity to speak further, answer any questions, and really appreciate the committee considering the passage of this bill. I think it would help our farm families tremendously.
Great. Okay. Any other questions? Seeing none, I thank you for your time, Joan.
Okay, thank you. You have a good day. Thank you, everyone.
Take care. You too. You too. Okay, Madam Clerk, remind me who we have next.
It appears that we have Natalie Pappas. I'm missing some.
Hey, is Natalie with us? There's Natalie.
Yes, hi, how are you
Hi,
doing?
welcome, Natalie.
Thank you.
Thank you for joining us.
Thank you. I'd like to thank the committee for the opportunity to speak today in regards to our concern with Senate Bill 272. My name is Natalie Pappas, and I'm here on behalf of the Small Business Finance Association, or the SBFA. The SBFA is a leading trade association for the alternative financing providers who provide financing to small businesses. I'm also currently the assistant general counsel at one of the member companies called Rapid Finance, and we are headquartered in Bethesda, Maryland. Although the SBFA agrees there should be disclosures for commercial financing products, in its current form, SB 272 ultimately will cause more confusion for small businesses, as the disclosures required to be provided may be incorrect or misleading. Our main concern stems from the requirement to disclose an APR or an estimated APR. The estimated APR or an APR are required to be calculated in accordance with the Truth in Lending Act, or TILA. TILA was enacted strictly for consumer transactions, not for commercial transactions. TILA does not take into account the unique payment structures of some of these commercial financing products, such as that they do not have a fixed term, they have daily or weekly payments, and some do not even have a fixed payment, and others do not have an absolute right to repay. TILA has not taken into account in its calculations for these types of unique products. Moreover, even the Consumer Financial Protection Bureau and its recent proposed regulations for Section 1071 of Dodd-Frank stated, and I'm paraphrasing, that because these types of commercial products do not have a defined term or periodic payment amount, it would require a funding company to assume or estimate parts of an APR formula, which only increases complexity. This is not a simple calculation, and funding companies have to make a lot of assumptions in order to provide a small business with an estimated APR, which in turn could lead to misleading disclosures, even if that was not the intention of the funding company. And then just to go on to that, Mr. Grimm testified earlier saying that, while small businesses look at different disclosures, even though APR is there, it might not be the one they're really looking at. And even to further that point, he talked about how he refinanced his mortgage and he was ecstatic about the interest rate, but then he looked at all the fees and how it actually is going to cost him more. That's our other concern, besides the difficulty with calculating is a small business going to see, oh, I'm only getting a 15% APR. This must be the better product, instead of an 18% APR, where in actuality, the 15% actually is going to be a higher cost product than the 18%. So besides with the difficulties with calculating it, it could also be misleading, and, a small business could choose the product that actually is going to have a higher cost because they might look directly at the APR instead of all the other disclosures and costs associated with it. And as you're aware, California and New York, while they have passed bills, and this bill is modeled after New York, neither one have been implemented. California has gone through 8 iterations of comment letters with industry because they understand the complexities. New York has about, I think, 2 or 3, and even their Department of Financial Services has refused to put forward to implement the final regulations because they know the complexities are involved with this. They know that there's issues going on, so they're trying to make sure everything is finalized before it's even actually implemented. On the other hand, 3 days ago, Virginia legislature just passed a disclosure bill that does not have APR in it because the legislator realized how misleading it could be. So like I said, while there are issues with the bill, we are happy to work with committee to put forward a disclosure bill that is actually meaningful for small businesses. Thank you.
Thank you, Natalie. Appreciate your testimony. Certainly a very interesting issue. Lots of variables. Rep. Delnicki has a question.
Thank you, Mr. Chair, and thank you, Natalie, for testifying today. And you spoke to two states that have attempted to do this and have had difficulty with it. Have any other states done this? And if so, what was their experience?
Yes, so Virginia, 3 days ago, the bill just passed the legislature. It's waiting for the governor's signature. So it is basically a disclosure bill that, you would provide, how much financing you're getting, what the total repayment amount, if there's any other fees involved with it. But it does not require the disclosure of an annual percentage rate or an estimated annual percentage rate. And Utah is the same. It's going through the legislative process, and I believe it's waiting for governor's signature, or it's almost at that point. So there's two bills that are about to be, signed into law that provide disclosures for small businesses, but that do not have an APR as part of the disclosure because of all the challenges and complexities involved with it.
So just to kind of like a yes or no. So no state has successfully done this with a disclosure of APR?
So while they have been passed the legislature, none have been implemented. They are in the regulatory side of things with the commissioner who's ever actually promulgating it. So they haven't actually gone into effect as of today.
So then basically the answer would be no.
No, that's correct. Yes.
Okay. And my other question pertains to, because I've heard small business over and over and over again, and no one's really quantified who the small businesses are, what they are, et cetera. Can you quantify exactly what these businesses are, as opposed to just saying small businesses are using this?
Sure. So I guess it's a little bit twofold. One is there hasn't been a universal consensus on what a small business is. As part of what I mentioned, the CFPB dealing with the Section 1071, they're actually trying to define what a small business is and is working with everybody to try to get that consensus. Our view is it's pretty much any business. We do have our personal rapid finance. We do have some clients, that would have, sole, 2 to 3 employees, could have 10 up to, 100, 500. So it really just depends. So there really isn't a set definition. It really just depends on, I would say, some businesses that might have, 500 employees might like our financing because we could be a little bit more quicker than some traditional banks might be, or they might like, how our products operate over a traditional loan. So it could also be, some types of businesses that might not be, the small businesses you would think it's like, 5 employees or something like that. So it could be, it's a vast myriad of businesses, but I would say, I don't have the exact numbers. I could get you to see what our average client employee is. But unfortunately, I do not have any business that has only 5 members is considered, or 5 employees is considered a small business. And I think this is also part of the challenge with Section 1071 is trying to see who's exactly covered, because so many different people have different definitions of a small business. So this isn't just your question. It's a part of a larger question.
Okay, well, I thank you for your testimony here. I still don't have a good feel for the small businesses that are using it. I'll be candid with you. I was hoping you'd say, well, we have automobile dealers doing this, hardware stores doing it.
Sorry, if you would like
more what I was looking for.
Oh, I apologize. And yes, no. So we would have we have restaurants, nail salons, mechanics. Who else do we have? Different type of manufacturers, textiles. It runs across a gamut of different type of industries that you would see. So any type of business you would see downtown Main Street, as well as, some more manufacturers, as well as, different type of like mills and stuff like that. So it runs the gamut of different type of industries that we do provide financing to.
Well, I thank you for clarifying that answer and actually giving me an idea of specifically of who is benefiting, who is using it, et cetera. Thank you, Natalie, for coming out today, and thank you, Mr. Chair.
Thank you.
Thank you. I'll ask the same question a different way, I guess, in terms of loan amount. We have, as pointed out to me, $500,000 single transaction in the definition of provider, which I believe we probably got from New York, since this was based off of, I think originally off of what New York did. Can you tell me in your business, what is the average transaction size, and what is the average borrower? What is their total indebtedness? And I think you can get multiple advances or multiple loans, correct?
Yes. So for our loans, my company, Rapid Finance, we offer loans, line of credits, and what's typically referred to as a merchant cash advance. So our loans, the average size was ranging from $50,000 to $60,000. And then the merchant cash advance was a little bit smaller, I think ranging between $30,000 and $40,000. Our line of credit is a newer product, so I do not have those metrics for you, but I can get those for you. So that's pretty much the average. However, our financing goes anywhere from $5,000 up to $1 million. But as you can see from the average, it's definitely smaller than the $500,000.
Okay. All right. That's helpful. Thank you. And I want to thank you as well for bringing the Virginia legislation to our attention. Definitely would like to take a closer look at that. And if you haven't submitted written testimony to us, we would certainly gratefully accept that, and anything else that you wanted to add, because we do value your expertise in the industry, so it's helpful to us.
I appreciate it. We did submit written testimony, and the Virginia bill was just released this morning in the final draft, so I'm able to submit that as well if you would like to take a look.
Interesting. Yeah, that'd be great. That'd be great. Thank you.
Thank you. I appreciate
Okay,
it.
seeing no other questions, I'll thank you for your testimony today, and have a nice afternoon.
Thank you. Same to you.
Okay, Madam Clerk.
Mr. Chair, it appears we have number 21, Min Chen, but I'm not sure. There was some discussion that maybe someone was sitting in for this person.
I'm here.
Okay, thank you.
No, I think, yeah, she's, Ms. Chen is on our list. So, Ms. Chen, welcome.
Hi, welcome. Well, not welcome. Thank you. Thank you, committee members, for allowing me the opportunity to be here today and allowing myself to represent the asset-based lending and factoring community here in Connecticut as it relates to SB 272. A quick background, my name is Min Chen, currently the COO of Sienna Lending, and I've been here for almost 8 years. Prior to joining Sienna, I was the controller for Burdale Capital Finance, as well as various roles at public accounting firms. Collectively, I've had almost 20 years of experience in the industry. Sienna Lending Group is an asset-based lender based in Stamford. Our business is providing facilities that help our target demographic of middle market companies who need working capital and lines of credit. These companies have annual revenues of about 20 million up to upwards of 500 million. These facilities are revolving in nature, have initial tenures of 3 years with possible extensions, and loan balances can go up and down depending on natural seasonality of the business, current events, and marketplace disruptions or lack thereof. As their sales goes up, so does their receivables and theoretically their availability to borrow. However, if the receivables do not collect, their availability could shrink. Sometimes this is timing, sometimes it's due to something that's happening in the industry, and sometimes it could be due to a particular relationship. Point being, there is a lot that can occur, which makes the APR concept that much more difficult to fit into our business model. Calculation of APR is used for generally something fixed, as we've heard, mortgages, car loans, but it's not for a revolving line of credit because of so many variable factors that would unfairly represent any APR calculation. For the APL and factoring world, calculating any APR will be based on a set of assumptions that can change rapidly, and this is not meaningful for any business's owner or lender. Before I even go further, I want to point out that through 2021, we, as in Sienna, have closed 152 deals totaling 1.8 billion facilities. In order to close that, we have to look at almost 3,000 opportunities that total over $34 billion. This is important because it points out the competitive landscape that we operate in. At the onset of the process, our clients receive letters of intent, or more commonly known as term sheets, from us that detail our expected terms. These are reviewed by the clients, and they get many letters, as you can see, and they make their own judgment on which terms and structures suit their needs best. They are often advised by sponsors or consultants who are more experienced in the space and more so on what the company needs in their economic lifestyle cycle. This is not a consumer signing up for a credit card or a local store owner going for loans. These are highly skilled individuals who have consultants that they rely on, who are there to look out for the best interests of the company who are entering into these loans. Our association also has standards that we work with and are understood within our industry, not to mention sponsors, consultants, and lawyers that work on multiple deals at multiple times, and lenders who do due diligence on it, who will absolutely point out what's acceptable in the industry and what they have seen in the marketplace. This is where the market is efficient, and adding disclosures that, in my opinion, cannot be accurately calculated will only lead to more time wasted on interpreting the calculation and taking away from what we truly want to do as an industry, which is to get working capital in the hands of middle market businesses so that it can continue to do what they are passionate and good at.
Thank you, Ms. Chen. Any questions from the committee? Ms. Chen, I have one. I assume you heard our last speaker. I had asked about loan size at her company. What about at yours? Is it comparable? Are you doing a lot of very small cash advances, or what's your average loan size?
So Sienna Lane Group is an asset-based lender. We lend based off of accounts receivable and inventory of a company. Our general loan size outstandings is about $8 to $10 million. Facility size, it's probably around 12 to 15, maybe a little bit upwards. So we're not talking small businesses who are looking for $50,000 loans overnight. These businesses come to us, they go through a comprehensive diligence process where they are represented by, again, consultants, sponsors, lawyers. The process from getting a term sheet to closing a deal could take anywhere between 45 to 90 days. It's a very long process that's well vetted, constant communication with the clients, as well as we also have relationship managers who deal with these clients on a day-to-day basis, understanding, what's going on in their company, at their industry, how we need to change the loan agreements to kind of be able to give them the best liquidity that they need. So all of these, there's so many factors, it's really ever-changing, completely variable, that we don't know any of this at the onset of a loan agreement.
So would most of your business then be carved out under the definition of a provider, which excludes individual financing transactions over 500,000, or do you still do some small loans? And that's
we do
the concerns.
Sorry, we do still have some small loans, but in general, I would say that that dollar amount, it's going to be hard for anybody who's doing a revolving line of credit to fit themselves into an APR definition.
Okay, understood. Rep. Delnicki has a question.
Thank you, Chair. And thank you, Ms. Chen. I raised this issue with someone earlier in testimony that offers these loans, and I'm wondering what your take is on this. And this pertains to you have a very difficult time trying to determine an APR on the front end, correct? Well, if you have a difficulty doing that, at the point of end of the loan, could you then disclose what an effective APR was based on the loan payment, et cetera?
Yes. So at the end of the loan, you could definitely, because at that point it's fine. The loan balances, all the interest and fees, you could definitely calculate the APR at the end of the loan. However, actually, Representative Delnicki, I wrote it down on your question. I would say you can calculate it, but is it meaningful for the future? Probably not. Point being that, as I kind of stated before, businesses go through different economic life cycles, from growth to stabilization. At all those individual points, their borrowing base under our business will look very different. And the availability that's given to them will also be very different, which is also another way to say the liquidity that we're able to provide for them. So just strictly looking at the APR from your point of business today versus in 5 years what the APR would be, it would not give you an accurate portrayal because our business works around the revolving nature of a business in general. Does that make sense? So yes, we can. Is it meaningful? I'm not too sure about that.
I'm glad you stated yes, you could, because at least at that point in time, the individual, the business, et cetera, would be able to take a look and say, well, gee, if I had a revolving line of credit or I utilized, say, one of the low interest credit cards, they would have something to judge it against, and it would probably help for future situations for a small business if they chose to do it again, from that perspective.
It could help, but I believe the prior speaker that talked, I think her name was Natalie, she pointed out that having the APR, if it's 15% versus 18%, because our business is structured around very comprehensive structures of how to make these loans, if somebody was just looking for the lowest APR, they might be missing out on a great opportunity to be able to have more liquidity. And that might be what they need. So while APR is great in certain situations, we believe that for, I would call the middle market business, and hopefully you appreciate the definition of 50 to 500 million. It's not that it's meaningless, it's that there's so much more that goes on with these loans that just looking at the APR, and when people look at it, just being tunnel vision on that could actually be detrimental to their business.
Well, thank you for your answer, and I appreciate the opportunity to ask you a couple of questions. Thank you, Mr. Chair, and thank you, Min.
Thank you.
Thank you, Rep. Delnicki. Any other questions? I don't see any. So I'll thank you for your testimony, Ms. Chen, and enjoy the rest of your day. All right, up next, I see Deb Poland. Is that next on our list? Sir. Madam Clerk? Okay, great. Welcome, Deb.
Thank you. Thanks for having me. And good afternoon, Representative Doucette, Representative Delnicki, and the rest of the committee. For the record, my name is Deb Poland. I'm the Executive Director of the Connecticut Association for Community Action. We're the state association that works with the state's 9 community action agencies. And I'm here to testify in support of House Bill 5315, the bill that establishes a financial wellness trust fund. It has a lot more words in the title, but I've submitted written testimony as well. But because I don't typically come before this committee, I want to take a few minutes just to explain to you a little bit about the work of the community action agencies. These are anti-poverty agencies designated by the federal and state governments. There are 1,000 across the country and 9 here in Connecticut that each serve their own geographic catchment area. So all of you have constituents who utilize community action agencies across the state, and our agency, the association here, we work with all of them to improve the work that they do and bring their voices to the Capitol and try to improve the lives of people who are in poverty and end poverty. All 9 of our community action agencies, in addition to providing services like energy assistance, SNAP enrollment, childcare, and job training, all 9 of them also provide financial literacy programming. And you've heard from Treasurer Wooden and also from Elizabeth Horton-Schaaf about the importance of financial literacy. I've been listening to the speakers before me today, and it has really driven home the importance of financial literacy. This is, really, really complicated stuff. And people who have grown up with lots of money often don't have a good sense of financial literacy. Those who have grown up in poverty have not had the opportunity to learn about saving because they haven't typically had money to save or invest. And that is one of the reasons why it's so important. It's also important to provide financial literacy for people to help them move out of poverty. And that's the goal, right? They can save money, maybe buy a house, start a business, pay for college or other certification classes. We also know that having low financial literacy can lead to poor credit. Poor credit then therefore makes your life more expensive. Your auto insurance is more expensive. You're going to get a higher interest rate for your mortgage and any of the other loans that you take. So financial literacy is really a win-win situation to help people learn how to participate in our society and also improve their lives both in the short and in the long term. They're also a great tie-in, these financial literacy programs, to the other programs that are run by community action agencies like volunteer income tax assistance, which almost all of our agencies provide, free income tax preparation, and also job training. So as people are moving into jobs that are higher paying, and also having case management around setting and maintaining goals around housing, education, and employment, tying in financial literacy just makes a ton of sense. So establishing this trust fund and a process by which these programs can be funded in a sustainable way just makes so much sense for people of all ages across our state. And I appreciate your support.
Thanks, Deb. Appreciate your testimony. Anyone have any questions? I did have one, and it's similar to what I asked Ms. Sheff earlier. I don't know if you were listening. It sounds like you were. So how would these programs be deployed into the community? I know there's already a number of programs, so maybe you could speak to just a few of those. Actually, I'm interested, again, how they get deployed, how they work on the ground, and I would like to see these sorts of programs going out into the community, bringing it, meeting people where they are, as opposed to trying to bring people in, which is fine too. She alluded to the institute that CRT has, but I'm more interested in outreach efforts. Talk about a little bit about how you think that could work if you had more resources under this bill.
Yeah, understandable. And most of our agencies, I believe, do provide their financial literacy programs on site, but their sites are in the community. So you know where CRT is located, and most of our agencies are located in areas that are easy to reach, either by public transportation, walking, or whatever other way that people would get there. Some of our agencies also run youth-oriented financial literacy, which I think is a great idea. In fact, I was just talking with one of our agency leaders earlier today, and they train teenagers to do the volunteer income tax assistance. So that's another scenario where the teenagers are helping other folks in their community and learning skills themselves that will benefit them later, and also tying that in with financial literacy. So they, because we have community action agencies in so many different places around the state, they are offered on site. That's where the physical locations are that they can offer them. I can check to see if any have been moving them to virtual though, because that does improve accessibility. And I will get back to you on that. I'll ask around that.
Right. No, that's good. And you said youth too. And as you're talking about that, it occurred to me, like, youth service bureaus in our towns, is there a way to partner with those to do some outreach there, bring those programs to them, and train some of those teens who might want to be involved with something like the VITA program, or, go into the schools, perhaps on a sort of extracurricular basis. We have some into, a club or sort of an extracurricular type of a program that your organizations could partner with as part of this. Just throwing things out there, because again, what I very much like to see is sort of this type of thing have broad reach, and your organizations are doing a great job, and I'm excited for this to again expand the reach of these programs.
Yeah, those are all great ideas.
Thank you, Mr. Chair. And some of your commentary actually created a question in my mind pertaining to this whole situation here. Deb, have any of you partnered with credit unions or banks to offer a program that actually brings those folks in to explain a lot of this stuff, to help educate folks?
I believe the answer is yes. I also, since you mentioned credit unions and banks, wanted to remember to share with you that a few of our agencies also offer individual development accounts. And so that is a way that people are actually given money to seed their investing and saving. And so that's another program I'd really love to see expanded. I think it got started here under Treasurer Napier about a dozen years ago or so. But yes, I do believe that they have local partnerships with their local banks and credit unions, and that can be really beneficial as well, because then you're establishing the relationships with the people who you might see if you go into make a deposit or to take money out. So yeah, those are good programs as well.
So do you see this program here as a way to buoy those sort of activities that are going on with credit unions and banks?
Absolutely. Anything that can provide more stability and sort of long-term planning for these financial literacy programs is good. You know, right now they're sort of the agencies are committed to doing them, but to know that there would be a trust fund established that would fund these moving forward would allow the agencies to plan for additional partnerships, perhaps additional sites, more population served. Those are, you know, the more financial literacy. This is one of those situations where like more is more and more is better.
Well, I appreciate the answer. And thank you for coming forward and testifying. Thank you, Mr. Chair, for the opportunity to ask a couple of questions.
Thank you.
Thank you, Rep. Delnicki. Okay, I don't see any other hands at this time. So I will thank you for your testimony, Deb.
Thank you so much.
And great to see you on the banking committee. Come back anytime.
I will. Thank you.
All right. I believe next on our list is Scott Rosenberg, and I see him in the room as well. Okay, there he is. Hi, Scott.
Yes, thank you. I was just admiring Deb's testimony. When I was first starting out, I was volunteered with their sister program, Tax Counseling for the Elderly. But Mr. Chairman, ranking members, Bethel Delnicki, members of the committee, my name is Scott Rosenberg. I'm the secretary of the Elder Law section of the Bar Association. I'm going to try and put a capstone on the testimony today about Senate Bill 269, an act concerning protection of the elderly from financial exploitation, of which we oppose Section 1, which is the part that does not deal with the bank statements. I hope you'll forgive my lack of polish. I'm going to try and elaborate on what's already been said rather than go blank, but we certainly appreciate the testimony of Art and Tom, the fact that the Banking Association wants to go farther than just the mandatory training to be part of the solution. And as noted by Matt Smith, elder exploitation is a very significant problem throughout the country and no less so in Connecticut. I do disagree on one small thing he said, however, which is that the main reason for underreporting is shame. That may be true of elder fraud cases, lottery scams, telephone fraud, things of that nature. Elderly exploitation normally happens at the hands of a family member, or almost always by a person who is regularly involved in the senior's life, and often takes place over long periods of time. The main reason we see for not reporting, because when this gets discovered, they come to attorneys like myself and my colleagues in the section, is that the money's gone and they don't want to have their family member arrested if it's not going to get them the money back. So we appreciate the goal of this legislation, but we oppose it because it provides just a very small arrow in a very large shield. Putting a hold on a bank account or on a particular transaction, if fraud is suspicion, if someone appears to have someone leaning over their shoulder pressuring them, is good. Being able to go to a different branch and do that same transaction is bad. Being able to, or having the person 3 days later have their ATM card declined at the grocery store because the entire account has been held is bad. And If there is a daughter or a power of attorney or a joint account holder who's continuing to write checks that bounce and has not been told anything about this, that's really bad. The bankers bring up an excellent point about the many steps that could be taken to make a hold the first step and part of a solution, but none of that is mandated under this statute. It's kind of like if an engineer finds a crack in a dam and puts duct tape on it. Well, they should do that if duct tape's all they have, but they really need to tell their employers that there's a crack and that all they had was duct tape. You would not want it to be in the employee manual that they could just duct tape it and walk away, and that's the way the legislation is currently presented. And just to elaborate on one small point that I believe Art Corey brought up, referencing remedies in my testimony, the point I was making there was not to hold bankers accountable. We do think there should be some affirmative duties. Representative Paolillo mentioned having a mandatory trusted contact. We agree that should be part of legislation. FINRA has recommended that as a model rule for all states for broker advisors. But there should be affirmative steps that should not be ignorable. But the point about remedies is that the statute simply says a court of competent jurisdiction can overturn this, but without giving the superior court a particular guideline or a cause of action, there's no real way to do that. And I'm happy to elaborate. I don't elaborate if there's a question, but there's all very good reasons why the probate court might be a better venue. And as a statutory court, they need explicit jurisdiction, and we have language on that. But ultimately, they are a stakeholder in government. Protective Services is a stakeholder in government. The Department of Public Safety is a stakeholder. And we feel that continuing discussions about these are warranted and very important. And that's simply giving the bank the right to do a hold or a complete account hold, transactional or full account, without having to notify anyone, even joint owners, is not appropriate legislation to have at any point in time. I thank the committee for their time. I'll be happy to answer your questions.
Thank you, Scott. I really appreciate your testimony, your involvement in this. A lot of good ideas. It's obviously had a lot of knowledge on this, so would certainly welcome your continued participation in this discussion, because no doubt there will be one. Any questions for Scott? I do not see any hands at this time, but I appreciate. And did you submit written testimony as well to us?
I did.
Okay, great. So we have that. No, appreciate your time and joining us this afternoon.
Thank you.
All right, Madam Clerk, I believe that's the end of our list. The list I'm looking at least. Okay. So with that, I think we are done for now. I think there were a few members running around today between different meetings. So maybe we can leave the hearing open for attendance for a little while. Say just until
I'm gonna say 1:30, and I'll try to
1:30. Sure. Yep. Sounds good. Okay. Well, great. This has been a very informative hearing, and really appreciate all the good questions and, of course, all the great testimony. And we'll see you all soon. Thank you.
Take care now.
Hello, Representative Gucker.
How we doing?
Good.
I didn't have you
Okay.
on my schedule.
You didn't. I've sent it out a bunch of times. No worries.
No, it normally it shows right up in my calendar.
Okay. Yeah, I don't
Didn't-
know why.
It didn't do that.
Okay. My apologies.
No, it's
But,
okay.
I will mark you present.
Thank you very much.
Thank you.
Thank you for the note, because I was getting ready for a meeting at 3 o'clock. It was the only thing I had on my calendar today.
Oh my goodness, lucky you.
It's the first time in 2 weeks. I actually thought I could get, go take care of my chickens and do some other things.
No such luck. All right.
Thank
Talk
you
to
very
you
much.
later. Thank you.
Hello.
Hello, how are you?
Good. How you doing?
Good. All right.
You okay?
We are all set. Thank you.
All right.
Checking in.
Sure. Take care.